Equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. More Fed policymakers come out in favour of another rate hike. That's even as they monitor continuing bank strains. Asia stocks lower with European futures mixed. President Biden is said to be preparing an executive order to limit US business investment in key parts of China's economy. Plus, from price cuts to price hikes, Tesla increases the cost of its Model S and Model X vehicles in the US. That after the company's shares slumped, wiping $13 billion off Elon Musk's fortune.
Now, Tom, when you look at the futures, of course, sentiment was hurt yesterday by that weak data out of, well, some of the parts of the labor market. That's hurt sentiment. And so I guess European futures now struggling for a bit of direction.
Yeah, it certainly feels like we are now in the foothills of a recession in the US with mortgages, real estate, house prices coming off. Then you had the slump in manufacturing, the slowdown in manufacturing. And finally, at least from the perspective of the Fed, some softness coming through from the labor market. So markets now repricing just how much has to come through in terms of rate hikes from the Federal Reserve. Still expecting, though, when you type in the WERP into your Bloomberg terminal, to see cuts towards the end of this year. Again, officials really cementing the view that you're going to get another move in May. The debate remains to what extent they go and how far they go after that. Here in the UK, you're seeing losses of 0.2%, a drop of 14 points. The Spanish IBEX down 0.3%. We're waiting for additional data to kind of round out the picture on the Eurozone just in the next hour or so out of Europe. Again, how that plays into the views of the ECB. Let's switch it on and see how things are working their way through across these assets. At the front end then, yields have come off on that repricing of just how many more hikes are coming through from the Fed. The 2-year currently at 4.12. That's a move lower by 2 basis points after an almost 10 basis point move yesterday. You were at 4.20 at the beginning of this week. Futures in the US pointing to losses of 0.1%. The Bloomberg Dollar Index, really interesting. You're now seeing the greenback coming back for the week. The first time, the first weekly gain, it seems, for 6 weeks. Gains of 0.2%. Iron ore, this is the commodity to watch. Under pressure today, drops of almost 6%. That's on softer demand from China, coupled with the fact that there is actually more supply in the market. And of course, layering on top of that, the overall sentiment around these recession risks. Fran.
Yeah, so Tom, actually, given the fact that we're seeing quite a lot of pressure on iron ore, if you look at the 20 groups that make up the stock 600, it's really basic resources that's losing the most. So we have basic resources down 1.7% as an industry groups. I have to say it's pretty much split, but actually the biggest loser, so basic resources, then you have travel and leisure down 0.7%, real estate also down 0.5%, and then the gains, when you look at the industry groups, which is a really mixed picture, the gains are not huge highs. They're gaining between 0.2 and 0.4%, Tom.
Yeah, so the playoff between the economic data, the Fed speak, and of course the earnings picture as well. Talking of Fed speak, Fed officials are backing another rate hike as they keep an eye out for economic fallout from the banking turmoil. That's as fresh emergency loan data shows financial stress continues to linger. Cleveland Fed President Loretta Mester says she favors getting rates above 5% because inflation, in her view, is still too high.
I anticipate that monetary policy will need to move somewhat further into restrictive territory this year, with the Fed funds rate moving above 5% and the real Fed funds rate staying in positive territory for some time. Now, precisely how much higher the Fed funds rate will need to go from here and for how long policy will need to remain restrictive will depend on economic and financial developments.
Okay, we're joined now by Bloomberg Markets Live cross-asset strategist Ven Ram. Ven, your thoughts then on what we've been hearing from the Fed and weighing that up against what looks like at least significantly softer data it remains relatively resilient, the US economy, but again, it feels to me like we may be in the foothills of a recession in the US, given what we're seeing in terms of jobs, manufacturing, and how you weigh up the Fed officials speak.
Morning, Tom. That's a very nice way of describing the foothills of a recession. I really like it. Well, I mean, definitely the US economy has lost momentum. It is losing momentum as we speak. There is no question about it. But I think that, the long tail of the economic expansion, particularly the tight labor market, is going to continue for a while. So I think we may start to see those see those markers coming off in the second half, where the economy really goes turns pear-shaped. And I think that that's what the Fed is worried about, that there is this interim period where they've got to manage inflation expectations. And I do think that, as Loretta Mester said, we will get to 525. If you look at the Fed dot plot for March, fully 7 policymakers thought that the top end of the Fed's benchmark rate ought to be 550 or greater. So I think that is what we need to focus on in the interim before the economy heals over.
Ven, give us a sense of what kind of jobs market you're expecting. So I think even worst case scenario, we're still in a fairly strong labor market in the US. What if we were all wrong on that?
Well, I mean, the Fed is forecasting, the Fed thinks that the employment rate needs to go up to 4.5% this year in order to bring demand in alignment with supply. And last month, if you look at the numbers, the jobless rate actually ticked lower by a notch to 3.5%. So we are nowhere in that balance that the Fed thinks the jobless rate needs to be to achieve that balance. So I do think that we've got a long way to go. And the jobs market data is lagging, and we won't, which is why I was saying earlier that we won't see the tightness in the labor market let up before the second half of the year.
Ben, I want to switch focus to the BOE. Some remarkable comments coming through from the key dove on the board there, Silvana Tenreiro, comparing her hawkish colleagues to fools in the shower, desperate to ramp up the heat, not patient enough to wait for that warmth to come through, and at risk of burning themselves. Markets now pricing in close to 5% from the BOE on higher inflation and stickier wages. What is your take on these comments from the key dove within the BOE?
Well, with all due respect to her, she talks about long policy lags. So by that logic, the BOE should have been able to get inflation back to 2% by now, considering that they started raising rates much before the Fed, much before the ECB in the current cycle. She talks about forward-looking forecasts. So the BOE's own forward-looking forecasts on inflation have been way too wrong for 2 years now. So I wonder whose forecast she's referring to. She also doesn't say what numerical models she's using. One of the most renowned models used universally by economists is the famous Taylor rule, which, if you see on the Bloomberg terminal right now, would give you a rate above 10%. So I would like to know what model the BOE uses, which shows a policy rate at 4.25 is restrictive when inflation is running above 10%. The fact of the matter is that the BOE has missed its inflation target for 2 years now, and they will likely miss it for another couple of years from the looks of it. And if you think about it, the irony of the matter is that the BOE's only mandate is to get inflation back down to 2%. So I wonder who the fool in the shower has really been all this while.
Okay, Ben, but not pulling your punches there. I like it. Possibly another 2 years of the BOE missing their inflation targets. 2%, of course, is the target. Bloomberg, MLive, cross-asset strategies, always excellent in all things rates and the central banks. Ben Ram, thank you. Let's check in the auto sector then. Autos as a sector this morning gaining 0.8%. There's a couple of different components coming through. Mercedes beating pretty handedly. Just a reminder that at high end of the auto market, you are still getting those margins. They got margins of around 14%, and that is helping their fund around the switch to EVs. Mercedes gaining 2%. There was a bit of hit for the likes of Renault yesterday. That fell almost 8% the last time I checked on the session yesterday on concerns around pricing pressure coming through from the likes of Tesla after the cuts. Tesla then reversing course, at least to some extent, with the more premium versions of their models like the S, with some increases in prices just in the last couple of hours. So rewriting how things are shaping up in terms of pricing across the auto sector. VW kind of gaining 0.7%, and pretty decent uplift for Volvo cars as well, 1.3%. So moves, that is the leading sector in the session today. This Friday, autos up 0.8%. Okay, coming up, Tesla, as I mentioned, raising some of its prices after shares slumped on first quarter results. A real hit to Elon Musk's wealth as well. We discuss that next. This is Bloomberg.
think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
This is Bloomberg.
Well, I think at the end of the day, the crisis is too strong a word, and words like that get used a lot. But at the end of the day, there was a fair amount of disruption for a few weeks there. Well, certain business models were sorted through, but on the other hand, you could see, and we could see, the stability in the other business models.
The Bank of America Chief Executive Officer Brian Moynihan weighing in on the recent industry turmoil at Bloomberg's Southside Leaders Forum in New York. Well, joining us now is Michael Moore, our managing editor for EMEA Finance. So, Mike, when you look at the complex actually for banks across the board, what can we take away from the earnings season so far in the U.S.?
I think what transfers over perhaps to the Europeans is that if you arrange yourself well and you didn't get burned on the bond investments, higher interest rates are still a major tailwind for the banks. We saw that JP Morgan raising their guidance, net interest income up at all the major banks. We expect it to be at most of the European banks as well. So higher interest rates still, that thesis is not broken as long as you didn't pile into long-term treasuries in the low rate years.
And I guess we'll get some clarity from European banks as to their exposure to kind of some of those risks next week, as well as asset quality. What else are you and the team going to be kind of scrutinizing out of those earnings next week?
Yeah, I think, it kicks off Monday and Tuesday with Credit Suisse and UBS. And I think the big question is, what is UBS getting here? Obviously, Credit Suisse saw a lot of outflows in March. Just what was the scale of that? How, healthy or damaged is that wealth franchise? And that was the big crown jewel for UBS to take on. So how much of that is still remaining, and what are UBS's plans going forward? We've heard, kind of broad outlines about the integration taking a long time, but do they start to drill into more specifics now that we're getting closer to that deal being closed?
Okay, Michael Moore on the preview for those European earnings and a little reflection on what came through this week from the US. Let's get the Bloomberg Business Flash now with Alex Morgan. Alex, thanks.
Good morning, Tom. Thank you. Bloomberg has learned that the US President Joe Biden plans to sign an executive order in the coming weeks that will limit investment in key parts of China's economy by American business. The administration has been debating those measures aimed at the high-tech industries for almost 2 years now. Well, G7 partners of the US have been briefed, even though they're not expected to announce similar restrictions at the same time. Carlyle Group is said to be considering bringing in fresh backers for its investment in McDonald's Chinese operations. The buyout firm, which controls the China business with TrueStar Capital, is seeking a valuation of around $8 to $10 billion. The potential deal would allow new investors to gain exposure to the firm. And the latest attempt by SpaceX to launch its Starship rocket has ended in a blast. That's after an engine failure forced it to blow up the launcher shortly after liftoff. The test was intended to demonstrate the vehicle could reach space and complete a partial orbit of Earth. The mishap complicates CEO Elon Musk's goal of sending humans back to the moon. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan. This is Bloomberg.
Alex Morgan here in London. Thank you very much indeed. Right. Let's go to the story around Tesla then. We're talking there about SpaceX. Tesla, though, increasing the prices of Model S and Model X vehicles in the US. Yes, you heard that right. Increasing the prices this time. It comes after the company's shares fell following first quarter earnings. That slump driven by worries over recent cuts to Tesla's car price and what it does to those margins. Let's bring in another Alex now. This is the Alex segment. Bloomberg's Alex Webb. Alex, what's happening? Is this a U-turn from Tesla? What are they doing on prices?
Because they need to practice the Alexander technique.
Yes,
so Tesla, their prices, they've been cutting them quite substantially this year. If we take the Model S, for instance, at the start of the year it was $105,000 more or less. They'd cut that right the way down to $85,000. The stock really has suffered quite a lot, partly as a consequence of that. This week it was down around 12% at one stage. And part of the concern is that one of the reasons people invest in Tesla is that not only is it growing, but it is growing a product category they think is quite resilient, or a lot of investors thought was quite resilient from a pricing perspective. By cutting the prices, you're changing the narrative on that a little bit. You're saying, well, we can still grow at pace, but not necessarily at the price point or necessarily at the gross margins that we were talking about before. So what we've seen is a slight retrenchment now. It's only on two models, the Model S and the Model X.
And these are the more premium, pricier models.
And the increase, it's 2 to 3%, not going right back up that sort of, $15,000 to $30,000 delta that had.
But more broadly, this is the pricing changes coming through from Tesla is leading to ripple effects and waves across the auto sector. We heard from Farley, the CEO of Ford, saying that we could be in a place now we're getting into a price war around the auto sector. What is your take on kind of where things stand on that front?
Well, it's pretty interesting. He was invoking actually that Henry Ford sort of started this strategy by cutting the price of the Model T by 50%, going back 100, 120 years. The thing he also said, though, is that did not succeed, that Chevrolet overtook Ford around that time. I suspect there's a little bit of strategy at play here, because he's saying it's commoditizing the electric vehicle market. Well, commodification is what Tesla investors do not want. The moment that becomes a commodity, it is not a premium product. You're not getting the same margins. For the rest of the car industry, it is broadly a commoditized market. That's why we've seen huge waves of consolidation over the past 10 years as they try to build insurmountable scale. That's why we've seen Stellantis. That's why we've seen Volkswagen add 12 brands, or has something like 12 brands now. All these tie-ups are an effort to combat the commodification. Tesla was the standout in that. He is trying to paint the picture, Jim Farley, the Ford CEO, saying Tesla's going to be just like the rest of us.
Okay, really, really interesting comments there from the head of Ford. Alex, thank you for breaking that down for us. And of course, the price changes coming through from Tesla, what it means for the broader auto sector. Some redheads crossing the terminal now. That gives us a little bit of clarity in terms of the health of the European economy, particularly with the focus on France. French April services PMI rising to 56.3, well above the forecasts of 53.5. But here's the divergence. When you look at manufacturing PMI coming in below the forecasts, manufacturing PMI for the same month, the month of April, coming in at 45.5. Of course, within that contractionary territory of below the 50 line, the forecast was for 47.8. So a miss there on manufacturing, a beat on services for French April PMI, and a reminder of the split there across that economy. The euro currently at 109, just falling 0.2%, arguably more of a dollar story, dollar strength coming through on a bit of a geopolitical safe haven bid for the greenback. But that's the numbers in terms of the PMI from France. We're getting more data out of the Eurozone in the next hour or so. Coming up, UK retail sales fall more than expected in March. We discussed the pressure on consumers as inflation remains in double digits, but consumer confidence actually picks up for the first time since the war in Ukraine. What it all means for the Bank of England. That is next. This is Bloomberg.
Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Welcome back to the Open, 21 minutes into the European trading day. A lack of direction across these markets. European equities are flat. Futures in the US are down just 0.1%, weighing up the commentary from Fed officials. The data coming through in terms of the softness on the labor market in the US and manufacturing. And of course, here in Europe as well, the data coming through, a miss in terms of manufacturing out of France, but strength coming through for the services sector. Across your sectors, by the way, autos, a bit of a turnaround in its fortunes, at least for now, gains of 0.8%. But let's drill into some of the individual names. Joe Easton has his eye on the interesting individual equity stories for us. Joe, what's in focus?
That's right, Tom. So I'm scratching my head a bit over SAP. They had better than expected sales and also some better costs as well, as they do announce a restructuring. Yet that stock a little bit lower, down around 0.3%. Just read a research note saying they've paid out quite a lot to investors in terms of shareholder compensation this quarter. So that might be the reason, a bit of a technical decline for that one. Meanwhile, Mercedes, that one a bit clearer, doing really well in their luxury vehicle space. That's allowing them to pass through some of their higher input costs in terms of energy and wages, keeping their margins higher, building up their cash flow, and allowing them to potentially pay out more in dividends. So that stock is liking that and rebounding following those losses in the autos that you mentioned just a moment ago. Meanwhile, the best performer today is EssilorLuxottica, that one up 5%. The eye care giant, not only are they doing well in terms of sales of Ray-Bans and Oakleys, but also their prescription eye care business, so contact lenses, prescription glasses, is seen as being pretty resilient as we go through the recession. People might delay those purchases, but won't cancel them entirely. That stock getting a big boost. Meanwhile, Network International here in London up 11%. They've got a counter offer from Brookfield Asset Management at 400p a share. The stock is rising to that amount. They previously got bids from CVC Partners and Francisco Partners, two private equity giants in the US. This firm does tower networks over in Israel, but is traded here in London. That's the best performer in the UK today, as I say, up around 11%.
Okay, nice one, Joe. Ending on a deal story for us there, as well as a look at the sunglasses market. I have no doubt propelled to some extent by Joe Easton's summer sunglasses purchases. Now, UK retail sales, talking of purchases, they've fallen more than expected in March. After 2 months of gains, consumers have cut back on splashing the cash. A reminder that inflationary pressure on household budgets continues, but consumer sentiment has picked up. For more, we're joined by Anna Andrade, economist at Bloomberg Economics. Anna, what do the retail sales tell us? And we're going to look ahead to PMIs, but let's start with retail sales and that consumer confidence.
Yeah, so the retail sales came in a bit lower than consensus expected, but I just wouldn't read too much into that, just because we had two very strong gains in the past, and overall the contribution on the quarter is likely to be positive for GDP. For confidence, it's just kind of the confidence numbers that we had today just kind of fit the pattern that we've seen since the start of the year, which has pointed to a very strong economy. And what's happening, while the worst of the energy crisis is over, the labor market remains strong, households are still sitting on excess savings, so all of this is kind of, fueling momentum.
Consumer confidence at a 14-month high. It's still kind of remarkable to me that we're at that point.
Yeah.
Look ahead to the PMI data then. We've just been talking about France, the split between manufacturing and services. Will we see a similar kind of picture here? What is the resilience of manufacturing and services in the UK?
Well, so for the UK, the PMI in the UK has moved to expansionary territory 2 months ago, and we expect it to hold in expansionary territory this month as well. This is a story that's been mostly driven by services. And again, businesses have quoted resilience in customer demand, improved confidence. People mention a lower inflation ahead. So I think this is mostly a services story, although we've also seen kind of an improvement in manufacturing driven by an easing of supply chains.
Okay, Anna Andrade, thank you very much indeed for the preview of the PMI and just working through what's happening across the retail and the relative resilience that still holds for the UK consumer. Our economist at Bloomberg Economics. Let's briefly check in on the commodities market. Recession concerns, arguably a build-out of surplus around iron ore and softer demand coming through from China. A number of the major manufacturers of steel have shut down for maintenance repairs in Tangshan, which is a major steel-producing part of China. You're seeing a hit there of iron ore, down 6%. So a significant hit there for iron ore, again, on surplus in terms of the production of iron ore and softer demand. Brent oil currently down 0.4%, back at $80 a barrel, back below $81 a barrel, and pairing all of the gains that we saw essentially since that surprise OPEC Plus cut, down about 7% for the week for Brent. NYMEX crude also lower by 0.4 at $77 a barrel. You can also, of course, tie in the recession risks around the US. Coming up, Bank of Italy Governor Ignazio Visco joins us live here in London. We are going to discuss the ECB's inflation fight, the banking crisis fallout, and much more. That is an exclusive interview. It is next. This is Bloomberg.
Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people?
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. More Fed policymakers coming out in favour of another rate hike. That's even as they monitor continuing bank strains. European stocks struggle for direction. President Biden is said to be preparing an executive order to limit US business investment in key parts of China's economy. Plus, from price cuts to hikes, Tesla increases the cost of its Model S and Model X vehicles in the US. That's after the company's shares slumped, wiping $13 billion off Elon Musk's fortune. We have data coming through on the German economy, of course, the driver of the health of the Eurozone after manufacturing and services PMI came out for France. German April manufacturing then coming in, hang on a second, we're getting it. German April services PMI, let's start there, coming in at 55.7. That is a beat versus the forecast of 53.4. It's a significant beat, and it paints a picture similar to the one we saw in France, where services came in comfortably in expansionary territory above that 50 line and above the estimates for France. Similar picture in Germany. Manufacturing, though, was a disappointment in France, coming in below the expectations. And for Germany, the manufacturing PMI of 44, also lower than the forecast of 45.7. So it seems like across Europe, the major economies, the two major economies of France and Italy, manufacturing under pressure, services holding up in terms of resilience. Euro dollar, as you can see, down 0.2%, but dollar strength, greenback strength, is more of the play there. Across the benchmark, you're seeing losses of 0.2%. We talked about the lack of direction coming through for these markets. We have Fed officials really confirming that you're going to get that hike in May. The question is, what happens after that? Markets still pricing in towards the end of this year, cut back down to 4.4%. Earnings picture as well, slightly mixed. And in terms of what's happening in commodities and basic resources, we'll get onto that with the concerns around demand, particularly for iron ore. And China, there we go, top of the list. Healthcare, the safe haven tilt then, 0.7%. Utilities also getting a bid, 0.4%. This is very much a safe haven tilt. We're seeing it reflected in currencies as well, with the dollar index looking to its first weekly gain in about 6 weeks. Bottom of the list by a long way. Basic resources down 2.6%. Iron ore, the last time I checked, falling 5% on concerns about a glut of iron ore coming through the system and less demand than many had expected coming from China. That's a breakdown of your sectors 32 minutes into the European session. Now, ECB officials, including President Christine Lagarde, say there is still work to be done to defeat hot inflation across Europe. For more on this, let's go to Bloomberg's Francine Lacqua for an exclusive interview with a guest who is well placed to discuss, of course, the inflation outlook across the bloc. Fran.
Yeah, I'm delighted to be joined here in our London headquarters by Ignazio Visco. He's the central bank governor of Banca d'Italia. Thank you so much, Governor, for joining us. And what a day. We have a lot of PMIs. There's a lot of concern about what kind of economy we'll be left with in Europe. How do you see the inflation complex changing as we get more and more data?
Well, first of all, as we say, we need really to look at the data as they come. I mean, we live in a very high uncertain times, and therefore it is not obvious really to understand all the trends. We have to look at them one by one carefully. So the PMIs in Germany is just a component of all the information that we get. We have been moving from very low inflation rates in the mid-2021 to the peak of close to 11% last September, October. And now we are going down to 7%, less than 7% in the headline. Everybody points out, yes, there is a substantial reduction, but it is all due to energy prices going down. There's been extreme volatility in energy prices, extreme. It went from 10, 20 euros per megawatt hour to 350, and now it's 40. So there is certainly a pass-through of the energy price increases to final prices that we have been observing up to now. And this is why core prices still show an inflation rate which is stubborn. The issue is there will be a pass-through also in reverse.
Yes, but this you laid out yesterday very clearly in saying, look, things are too uncertain to know exactly what needs to happen next. What does it mean for interest rates? Do we need to pause, take a breath, and look at what happens?
As I said many times, obviously, we have to be, I think, cautious. It does not mean that we stop, or it means that we decide meeting by meeting on the basis of the information that we get. What kind of information are we going to look at? This is very important because obviously we know everything that happens to energy prices in the markets, wholesale, but then there are two main factors that are relevant there: wages and profits. And this is what we are looking at, whether the wages will make up and whether profit margins will remain unchanged.
And Governor, I understand you're data dependent, and I understand that it has to be on a meeting by meeting basis, but you also have to take a view on whether there's more of a danger of doing too much or too little at this point. Do you worry about doing too much?
I am saying that there are two risks. If we do too little, then there might be a risk of having to do more in the future and being more costly for the economy. If we do too much, well, we may overdo, especially now that there are some financial stability risks that we are understanding, not really directly relevant for the euro area, but contagion may be there and risks may be there. But especially if we do too much, there may be non-linear effects in the balance sheets. And we have a very clear indicator, that is what credit is doing now. And the rate of change of credit was very high in mid last year, and now it is, for business, negative. In real terms, in really negative territory. So this is an issue that we have to keep monitoring.
So could there be another banking crisis? Is that your worst case? I mean, if you look at the exogenous shocks and you talk about systemic risks, what's the probability of that?
Well, no, in Europe, the banking sector, it is in, I'd say, good shape. There is good regulation, supervision is correct. Liquidity is there, profitability also, so the capital ratios are sufficiently high, but especially the business model of the two banks that failed in the last month are not in Europe. So this is, on the other hand, we have learned two lessons. The first is that there is confidence that may change very quickly. And the second is that news nowadays, through social media and others, really can change the picture from 1 hour to the next. So this is why you have to be vigilant and perhaps also be more informed than we are now.
But so does it mean, what does that mean for regulation? So more informed, do you worry about bank runs? And so do we need to look at how we do mobile banking? Or is actually the way that banks behave in lending to consumers?
Well, the bank run that you have seen in the States is very different from the bank runs we studied in textbooks. Last year, they gave the Nobel Prize to those who looked at the bank runs, and from them came the deposit insurance schemes that have been very important up to now. They are not sufficient. We need to be ready to provide liquidity if a bank is solvent, but we have to understand. We have to monitor them very, very much. And if we provide liquidity, then in time, then I think this is also a message that the market understands. So there must be more interaction, certainly because of the times that are changing.
But given all this, do you actually worry about a credit crunch? And if yes, then it would also point to being much more cautious on interest rate hikes.
We do not have a credit crunch situation now, but we have a reduction in credit, certainly for the business sector, and a substantial slowdown for households. And this has taken place in a matter of months. So since monetary policy has effects over time, it is not immediate. Milton Friedman was talking about long and variable lags. And so long lags means that we have still to see all the effects of our monetary policy measures. This is why I'm saying that I don't exclude rising rates or whatever, but I think we have to be prudent, cautious, and patient.
Do you think some people on the ECB Governing Council just want to go too quickly?
Well, I'm not prepared to discuss what they may say in next week, because it is going to be discussed next week. I think that we have been very quick. There have been some criticism for the ECB responding a little bit too late. That's not true. First of all, inflation was still very subdued mid-2021. The increase in energy prices that took place in the fall, winter, was there, but it was not really very strong only after the Russian aggression to Ukraine. What we did already to announce at the end of 2021, our policy, and markets discounted it. So it has been. And then we have been moving rates of 350 basis points in a matter of 8 months. Yeah. So really substantial.
And this, I guess, is the key question. How much does it take to see it in the real economy? So I know you mentioned Milton Friedman, but are we talking 12 months or 18 months?
There are many estimates. They're all based on historical regularities. Somehow, rule of thumb says 18 months. This is more or less 1 year, 1 year and a half. This is more or less what it may be quicker. It may be quicker, especially now that we have seen the energy prices going down directly. The point is, will there be another shock? Do we have uncertainty reducing in the next months? I don't think so. I think that the geopolitical situation is very tense, and we have to be prepared. So, in this sense, I understand also the wait-and-see attitude of those who say, no, wait for a while before reducing the tightness.
But when you talk about geopolitics being maybe your number one worry, is this the interplay with China and Taiwan, or is it the more immediate invasion of Ukraine?
Well, I'm not a military expert, and I don't know what's going to happen there. I'm very worried about a return to a world divided in blocks. I think it would be very dangerous, not only for our societies and economies, but really for the ability that we have to maintain a sufficient rate of expansion, of growth, of development. And so that is an issue. On the other hand, it is clear that in order to solve these problems, economics or finance is not enough. You need diplomacy, you need politics, you need smart politicians.
Governor, I don't know how you would describe the relationship between central banks and the markets in the last 12 months. I don't know whether you describe it as difficult or mismatched.
Well, first of all, there is now some people who say that there is financial dominance. There used to be fiscal dominance because the central bank is not going to sell the bonds it has because it has fears that the debts might have problems. And now we have financial stability. I don't think that this is a relevant issue. I think that and markets actually, for the time being, are discounting well our actions. If you take as a single indicator inflation expectations from index-linked swaps, 10 years from now, you see they are flat at 2%. So the credibility there is still very, very strong. And I think it's wrong to say markets do not understand what we're doing, and it is at the same time wrong from the market saying, well, the central banks are a little bit confusing us.
We also had a pretty important speech about central bank independence that Christine Lagarde was talking. Do you think it's something that will come when we have all this complex geopolitical situation, the decision to either crush an economy if inflation stays high? Do you think that will be one of the dominant themes for central banks?
This is an important question, and I have to say that we have seen monetary policy the only game in town for too long. Even to combat inflation, central banks should not be left alone. You need the cooperation from the fiscal side, and you need also the business sector and the unions really understanding what is that they have to do in order to absorb what has been a shock from outside, a tax. Say, it used to be a shake tax in the 1970s. Now we have this different tax. You have to absorb, take it, and perhaps protect those who are hit, but at the same time increase your real incomes through changes in productivity, investment, and so on. This is what the firms have to do.
Governor Visco, thank you so much, as always, for joining us, of course, with a robust conversation on inflation and monetary policy. So with that, we'll have plenty more, of course, from, well, markets and interest rates as we look ahead to next week.
Okay, Francis Lankwa there with the Bank of Italy Governor and ECB Governing Council member Ignazio Visco. Coming up later today, we're going to speak to the Deputy CEO of Norway's Sovereign Wealth Fund. We'll discuss where the fund's first quarter results leave that fund in terms of the months and quarters ahead. That exclusive interview, 10:40 a.m. UK time. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Welcome back to the Open. Happy Friday, 48 minutes into the European trading day. Risk off across these equity markets. The dollar is bid across European stocks down 0.2%. Futures lower in the US of the S&P E-minis down 0.2%. And it is a risk off tilt across your sectors as well. Healthcare, utilities are bid. The losses, though, coming through pronounced for basic resources down 2.7%. Iron ore under pressure on lackluster China demand. Let's get the Bloomberg First Word News now with Alex Morgan. Alex.
Tom, thank you. Good morning. Some of Ukraine's key allies, including the US, are said to be weighing an outright ban on most exports to Russia. G7 officials are discussing the idea ahead of a leaders' summit in Japan next month. If that is agreed, it would be a significant tightening of restrictions, with all exports to Moscow banned unless exempt. The UK Prime Minister Rishi Sunak is weighing the fate of his deputy after receiving the findings of a 5-month investigation into bullying allegations against Dominic Raab. Bloomberg understands the report says the case against the Deputy Prime Minister is not clear-cut. Raab maintains he has not acted improperly. The euro area's 2 biggest economies have surged at the start of the second quarter, with private sector output jumping to the highest in around a year. The latest composite PMI for France rose to 53.8 in April. That's a much bigger increase than economists predicted, led by the services sector. Well, German data also beat forecasts, again driven by services. And Canada's National Police Force is investigating a heist at the country's busiest airport that may have netted the thieves there millions of dollars in gold and other valuables. Regional police say a container with around $15 million worth of valuables was taken from a cargo holding area at the Pearson International Airport. Gold mined in Canada frequently travels through the hub on its way to customers around the world. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Tom.
Alex Morgan here in London. Thank you very much indeed. Coming up, Biden aims to unveil limits to American investment in Chinese firms. That is in the coming weeks. The bifurcation, the split of those two economies continues, at least when it comes to technology. We're bringing the latest on that. That is next. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night. Bloomberg, top experts, great questions.
Welcome back to the Open. We are 53 minutes into the European trading day. Risk off across the equity markets, though the sell-off is less pronounced than it was even just a few minutes ago. Just down 0.1% across the European benchmark. We're in the green now for the FTSE 100, up 0.1% at 7,909. Talking of the UK, the pound under pressure, dropping by about 0.5% on the back of some weaker retail sales for the month of March. Currently at 123 on sterling, down 0.4, a little over 0.4%. Now, President Biden is said to be aiming to sign an executive order limiting key investments by American businesses to China. The order will focus on backing for chips, AI, and quantum computing in the world's second largest economy. Let's bring in Bloomberg's John Lill now, who leads our coverage across Greater China. John, what do we know then about the details of Biden's planned executive order?
So what we know, Tom, is that this executive order will target technologies that the U.S. thinks could help China's military close the lead that the United States currently has over Beijing. What we don't have is the exact details of what these rules will target. But as you said, I think those targets are not going to be difficult to guess. If you look at actions that the United States has taken already, it's very obvious that semiconductors, AI, supercomputing will be top of that list. We've seen already sanctions, limitations on what U.S. companies can sell to China. Now we are seeing the U.S. also target capital flows.
Okay, so it's the next step in that campaign around national security, is the way it's been characterized, of course, in the U.S. And meanwhile, John, comments, at least from reporting from Bloomberg, around what Taiwanese officials are saying about the U.S. kind of pushback on chips and reliance on Taiwanese chips. What are we hearing?
Well, we're hearing that the Taiwanese government is increasingly uncomfortable with the sort of rhetoric that is coming out of Washington when it comes to how much the U.S. and other countries depend on Taiwan to get the most advanced semiconductors. What has upset, especially Taiwanese officials, has been Commerce Secretary Raimondo's comments about how depending on Taiwan for these chips is unsafe. And so Taiwanese officials are speaking quietly, privately with their American counterparts to try and get them to calm some of that rhetoric. Taiwan, while it wants to build more chip fabs in the U.S., as TSMC has promised to do, it is not intending, nor is TSMC intending, to move its most advanced technologies to the United States.
Okay, so looking for a bit of nuance there from Taiwanese officials. John Lill in Beijing with the coverage, of course, of Greater China and overseeing that for us. Thank you, John. Let's check in on these markets then before we move to the next hour. You're seeing now losses just of 0.1% across European equities. Again, pairing some of the heavier losses. Futures in the US, the S&P EMEs and the Nasdaq futures down about 0.1% across the sectors. A bit of a safe haven tilt then to healthcare and utilities. Basic resources taking a thumping, down 2.4%, largely as a result of the pressure on iron ore and softer demand out of China. Continuing to weigh up the commentary from the Fed officials as you go into that dark period, and of course the earnings picture as well. The pound is down 0.5%. The Bloomberg Dollar Index is bid up 0.1% on a geopolitical risk haven move for the greenback, looking at the first week of gains for the dollar in about 6 weeks. That is it for the European market open. Surveillance early edition is up next. This is Bloomberg.
out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Services PMIs come in stronger than expected in Germany and France, but both miss on manufacturing. We'll bring you Eurozone figures in just a moment. President Biden is said to be preparing an executive order to limit U.S. business investment in key parts of China's economy. Plus, from price cuts to price hikes, Tesla increases the cost of its Model S and Model X vehicles in the U.S. after the company's shares slump, wiping $13 billion off Elon Musk's fortune. Now, we have the PMI. We also have a great exclusive interview from Governor Visco talking about the dynamics of PMIs in the Eurozone, how that feeds through their thinking, also on price hikes. Now, Euro area April manufacturing PMIs coming in softer than expected, just like we saw for Germany, 45.5. The forecast was of 48. Now, the way it's playing out in European stocks, not much of an impact, but it will certainly have an impact on central bank thinking. European stocks for the moment down 0.1%, euro dollar 109.57, and then iron ore really dragging basic resources down 6.3% for iron ore. And when you look at the industry groups that are following the most, basic resources definitely at the bottom list of that. Let's also look at the European map again, just to have a look at the difference PMIs. Overall, the picture here is pretty much unchanged. I think a lot of these European markets have to make a call on whether the figures that were concerning in the U.S. yesterday will also happen in Europe and what that means on whether we're getting closer to a recession or not. Now, joining us now is Bloomberg's Zoe Schneeweiss. Zoe, thank you for joining us. If you look at the PMIs, and we also had this conversation with Governor Visco of Banca d'Italia, if you look at services PMI, they're softer than expected.
So yes, overall numbers have increased. So the euro area is growing. Manufacturing PMIs is the thing we're really worried about here. They dropped a lot more than anticipated. They already were in negative territory. With PMIs, you always have to look at the number 50. Above that is growth. Below that is means that they're contracting. And PMIs there, manufacturing PMIs have been in that contractual area for months now. So for the euro area as a whole, the euro area is more reliant on services, which means that we overall have growth. But manufacturing obviously is worrying, and also is worrying what this says about inflation. Now, before these numbers just now, we had Germany and France. Again, both cases, the headline numbers were positive. Manufacturing was painful. For France, this is less of an issue than for Germany. Germany, as we know, is a manufacturing powerhouse, and manufacturing there takes a much bigger part of the economy, of output. So that is painful, and that maybe partly also helps explain why Germany probably just was in recession. We're getting GDP numbers a week from now, but that will probably show that, yeah.
So we also spoke to the governing council member of the ECB, Ignacio Visco, and he was saying, look, they should stick to its meeting-by-meeting approach to raising interest rates. You look at PMI, what does it mean for what the ECB should or shouldn't do going forward?
So the big question for May 4th is, will they raise by 25 or by 50 basis points? Some central bankers, that's particularly the dovish ones, say maybe it's even time to pause. But really, data does now suggest if the euro area as a whole is growing, and as we know, the euro area has an inflation target, not a growth target, but if it's growing, then that growth is something they don't need to worry about. So it could mean that they're more aggressive. Overall, that data-dependent approach is something that Visco makes, is something that we have to take into account, and this time will be particularly exciting because just 2 days before we have the rate decision, we get the inflation readings for April, and those really will be vital.
So, as always, thank you so much, Zoe Schneeweiss. They're in charge, of course, of all of our European coverage on economy. Now, Fed officials have backed another interest rate hike as they monitor the economic fallout from the banking crisis. It comes as fresh emergency loan data shows financial stress continues to linger. Meanwhile, the Fed's Loretta Mester says she favors getting rates above 5% because inflation is still too high.
I anticipate that monetary policy will need to move somewhat further into restrictive territory this year, with the Fed funds rate moving above 5% and the real Fed funds rate staying in positive territory for some time. Now, precisely how much higher the Fed funds rate will need to go from here and for how long policy will need to remain restrictive will depend on economic and financial developments.
Well, joining us now is Bloomberg's Justina Lee. Justina, thank you for joining us. When you look at everything that's going on in the market, sentiment definitely took a hit after the jobs data yesterday. What are they telling us about the future path towards a recession or not?
Yeah, it's interesting because it does feel like market's interpretation is that maybe a recession is coming, and so the Federal Reserve will end up having to cut rates later this year. And that is because, like, if you look at, U.S. data, the jobless claims as well as, home sales, it has slowed down a lot more. And I think what is interesting is if you look at the equity market, I mean, that seems to have just completely flown over equity traders' heads. So it will be interesting to see whether that starts to hit the equity market as well.
So what are you looking at for next? I don't know whether this changes the narrative on what the markets are expecting the Fed to do, in the run-up to summer.
Yeah, I mean, today's PMI numbers will definitely be key. I mean, currently economists are expecting a little bit of a slowdown, but for things to still in the expansionary area. And I think going forward, obviously, inflation data is key. And I think, with kind of markets already expecting the Fed to cut rates later this year. I think the question here is whether they're going to be disappointed if inflation does stay sticky, because that's what we have been seeing all along.
Justina, overall, we also had some soften actually in PMIs in the Eurozone. We had a good conversation with the European Central Bank Governor of Banca d'Italia in saying that basically, we should be a lot more cautious because we don't really know how long it takes for all of the hikes that they put last year to coming into force. Is that a warning from central banks around the world?
Yeah, and I think that's what central bankers in both the U.S. and Europe are thinking about, because if you consider the impact of, Credit Suisse or Silicon Valley Bank collapsing, I mean, what normally happens is that banks get a lot more cautious and they start to tighten lending. But of course, it takes some time for that to actually feed through to the real economy. And so I guess what central bankers are thinking about is that even if the data is holding up still fine, I mean, are they actually kind of ignoring the troubles that are brewing under the surface? And are they actually deepening those troubles by sticking to their path of monetary tightening?
Justina, what are you looking at, outside of this? We see iron ore really being slammed, and that's taking down a lot of basic resources companies. Is that also related? Is it an oversupply, question for iron ore, or is there a worry about a recession actually also denting demand?
Yeah, and I think, when it comes to commodities, obviously China is also going to be a big factor. We have seen kind of stronger data coming out of China recently. And so I think the question really is kind of also what's going to happen to China, and that is also going to feed through to global inflationary trends as well.
Justina, thank you so much, as always, for joining us. Justina Lee there from our MLive team. Coming up, Credit Suisse kicks off the European bank earnings next week. What are investors looking out for in the sector? We have a preview of that next, and this is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Stability risks that we are understanding, not really relevant, directly relevant for the euro area, but contagion may be there and risks may be there.
Well, that was our exclusive interview with the Bank of Italy Governor Ignazio Visco. Now for more, let's bring in Joost Beaumont. He's head of bank research at ABN AMRO. Joost, thank you so much for joining us. So many questions about central banks and about the interplay, actually, between how central banks view inflation, what they do on hikes, and how the markets are interpreting it. What's the biggest mistake right now that a central bank could do?
Well, that's a difficult question, of course. They indeed need to strike a finely balance between fighting inflation and preserving financial stability. I think it would be wrong for central banks if they would ease a little bit the fight to inflation, as that could cause more damage along the road. But on the other hand, they also need to look quite closely how the economy evolves, how bank balance sheets develop. But actually, I heard an interview with Mr. Visco, and he also said that banks are in a pretty good shape. And indeed, from a solvency perspective, this is indeed the case.
So, Joost, what does it mean for where you want to be invested in at the moment? We also saw some weak jobs data in the US. We saw some weak PMI data here in Europe. Are you looking at regionally, or do you really need to go for certain sectors more than others?
Well, in terms of where do you need to be invested in, if you look, for instance, as head of bank research, I closely look at banks. And what we're seeing is, of course, the Q1 figures so far from the US banks, from the most US banks were better than expected. We also see investors being pretty optimistic again after the tensions have flared up after the failure of Silicon Valley Bank. So if you look for Euro bank spreads, basically they are back at levels where they were before the tensions started. That in a way seems to match the good bank fundamentals, but on the other hand, I think financial markets and investors are not pricing in the weak economic conditions that are ahead of us.
Joost, what's the one thing that you wouldn't be buying right now? Is there something, and you know, everything's flagged as commercial real estate is the next thing that will go under. What if it were something else? Do you worry about parts of the market, whether it's liquidity or shadow banking, that the rest of the market is not focused on yet?
Yeah, it's the current market conditions it's stable. We clearly have entered calmer waters. Of course, the whole state of the market is still fragile, so it's difficult to see where the next crisis would come from. Of course, commercial real estate is in focus, but I also guess that a lot of regulators are looking at this and look at the banks that are most exposed to commercial real estate. And to be very honest, we do see some weakness there, but we also expect actually interest rates to reach the peak quite soon. So once rates will come down, that will of course be supportive for this part of the sector. So I think if you look at corporate earnings, then we see a bit of signs of some companies warning for earnings ahead of us. Also in terms of, if you look at the banks, for instance, I think the regional US banks also showed it that the cost of deposits and market funding is rising. So yeah, I think basically it's more that we will see a bit like an earnings slowdown for the rest of the year.
When you look at spreads on Euro bank debt, they've tightened considerably this week. I guess that points to confidence in the financial sector. What if they were wrong?
Yeah, if they're wrong, then spreads will spike again, of course. So that's clear. I think the lessons, of course, regulators are also looking at the lessons that they want to learn from the failure of the Silicon Valley Bank, but also the rescue of Credit Suisse. So it's clear that the Financial Stability Board, the Bank of International Settlements, they all say we will look at it. We might come with additional measures to limit risks ahead of us. That is a bit of a longer term issue, of course. But I do think that investors need to take into account bank lending conditions are already tightening significantly. We see lending growth slowing. Funding costs for banks will rise. We see also we're likely to see a recession, and a lot of companies still benefit also from government support. That will go away. So if you add that all up, we might see more corporate defaults, and I think loan loss provisions might need to rise in the banking sector, and that together with higher funding costs and just the impact of the sudden and strong increase in rates, that will have an impact on the sector. So I do think investors are at the moment a bit, at least more optimistic than I am. So I'm pretty cautious about the outlook for spreads.
This may be an unfair question, but is there another Credit Suisse?
Now there will always be another bank that will run into trouble over time, but at the moment I don't see really big troubles ahead. If you talk about solvency, but I guess the biggest lesson we have learned from everything that happened in March is that it's all you need trust as a bank, because if there's no investor trusting you any longer, then the money can flow out quite quickly, and then you can have a high CET1 ratio, good liquidity buffers, but that is not helpful. So that is also, to be honest, something that might be interesting for regulators to think about as well. We've seen, of course, these failures in the US, the rescue of Credit Suisse. I still do believe that were special cases in a way, And the fact that the market has calmed down so quickly is also a message that that the financial system actually is pretty strong. So regulators should also take that into account before they come with all kind of additional measures, I would say.
Yes, thank you so much, Joost Beaumont, there, head of bank research at ABN AMRO. Now, coming up, Biden aims to unveil limits to American investment in Chinese firms in the coming weeks. So we'll bring you that story next. And this is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it the OK is getting ready to make a decision?
Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results, impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, President Biden is said to be aiming to sign an executive order limiting key investments by American business to China. The order will actually focus on backing for chips, AI, and quantum computing in China. Well, joining us now is Bloomberg's John Liu, who leads our coverage across Greater China. So, John, thanks so much for joining us. What do we know about Biden's planned executive order?
So what we know is that the objective of these orders is to stop China's military from being able to close the sleeve that the United States has over Beijing at the moment. What we do not know are the specifics of what those rules will limit and how, but I do not think it is difficult to guess what will be targeted. Semiconductors, AI, supercomputing. If you look at the various steps that the Biden administration has already taken to stop American companies from selling sensitive technology and other products to China, it will be pretty easy to guess what investment areas the Biden administration will target when it tells American companies they can no longer invest in the Chinese firms that are making these technologies.
So, John, elsewhere, Taiwanese officials are also said to have urged the U.S. to tone down rhetoric about the dangers of relying on chips made in Taiwan. What more do we know about that?
Well, Taiwan is in this really tricky position. It needs the American security umbrella to protect it. But at the same time, the crown jewels, as you would say, of the Taiwanese economy is semiconductors. And so when Taiwanese officials hear people such as Commerce Secretary Raimondo saying that the United States depending on Taiwan for semiconductors is unsafe, that is going to be very unsettling for Taiwanese officials. And that's why they have been speaking privately to their American counterparts to try to calm the rhetoric coming out of Washington.
John, thank you so much. John Liu there in Beijing with the very latest, of course, on China. Now let's get straight to the Bloomberg First Word News with Alex Morgan. Hi, Alex.
Hi, Francine. Good morning. The EU area's two biggest economies have surged at the start of the second quarter, with private sector output jumping to the highest in around a year. The latest composite PMI for France rose to 53.8 in April. That's a much bigger increase than economists had predicted. That was led by the services sector. Well, German data also beat forecasts, again driven by services. The UK Prime Minister Rishi Sunak is weighing the fate of his deputy after receiving the findings of a 5-month investigation into bullying allegations against Dominic Raab. Bloomberg understands that report says the case against the Deputy Prime Minister is not clear-cut. Raab maintains he has not acted improperly. Some of Ukraine's key allies, including the US, are said to be weighing an outright ban on most exports to Russia. G7 officials are discussing that idea ahead of a leaders' summit in Japan next month. If it's agreed, it would be a significant tightening of restrictions, with all exports to Moscow banned unless they're exempted. And Canada's National Police Force is investigating a heist at the country's busiest airport that may have netted the thieves there millions of dollars in gold and other valuables. Regional police say a container with around $15 million worth of valuables was taken from a cargo holding area at the Pearson International Airport. Gold mined in Canada frequently travels through that hub on its way to customers around the world. I'm Alex Morgan in London.
Thank you so much, Alex. Now, coming up, UK PMI data is due in just a few minutes. We'll bring you the latest update, of course, on the UK economy as well. If you look at European indices, sentiment a little bit lower after we had some discouraging data out of the US yesterday. We'll have plenty more also with economic upswings, whether that intensifies with services. This is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. So sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Services PMIs come in stronger than expected in Germany, France, and the broader euro area, but all three miss on manufacturing, signaling, and uneven rebound for Europe's economy. President Biden is said to be preparing an executive order to limit U.S. business investments in key parts of China's economy, plus from price cuts to price hikes. Tesla increases the cost of its Model S and Model X vehicles in the U.S. after the company's shares slumped, wiping $13 billion off Elon Musk's fortune. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, this is a picture across the board for not only bonds, but equities. There are quite a lot of mixed earnings, and we get into the bank earnings next week. And then we also had some data in the U.S. yesterday, disappointing on jobs. And so traders today parsing that latest data, also out of PMI figures in Europe on the outlook for inflation and economic growth. Right. This is what we're seeing in UK PMIs. So UK April services PMI rising to 54.9. So this is actually better than expected. If you look at what we saw for the Eurozone and for Germany, it was worse than expected. Services PMI here in the UK, better. We were expecting 52.8. We actually got 54.9. A reminder that anything that is above 50 means that it's in expansion territory. Manufacturing, though, worse than expected, 46.6 instead of the 48.4 expected. You can see sterling just on the move on the back of that, a touch. 124.10 is what we're seeing for cable. Now, for more on the markets, let's go straight to Bloomberg's Christina Aquino. Christine, when you look at, good morning, first of all, when you look at the UK services data, so services better than expected, manufacturing not so much. What does it all mean for pound?
Well, Francine, I think it's going to be a complicated picture for the pound from here. I mean, we have seen, of course, quite the rally in sterling this year, and it's been heralded as the comeback kid of 2023 among major currencies. But I think it really still is quite a mixed picture when it comes to the UK economy. Again, as you mentioned, services doing a touch better, and that's great. I think that kind of helps shore up the story of a still resilient consumer, although that may be a little offset by the less positive retail sales data that we got earlier this morning. So very, very mixed picture for the consumer at this front. And then, of course, manufacturing, as you mentioned, weaker than expected still. And so there are still a lot of obstacles for the UK economy, right? I think we got into a mode where, we're avoiding the worst case scenario in that, the expectation for recession probably not there anymore, but it's still not roaring and firing on all cylinders.
All right, Christine, thank you so much. Christina Aquino there with the very latest, of course, on this data and the read across for what that means for sterling. Joining us off the back of that UK PMI data is also Bloomberg's senior editor for markets and opinion columnist, John Author. So, John, I wake up early in the morning. A lot of us are on the way here, and we read your columns because they're funny and they're smart. The last one, the Ministry of Silly Walks is not running Britain. I mean, so what are you looking at in the UK?
Well, first of all, any excuse to mention Monty Python is good by me, so I take that. I think in the UK, you have to look at the fact that we've had more of an inflation problem in this country than both the rest of Europe and the US, and obviously Japan, really forever. In the 1970s, Britain, it was an inflationary decade. Britain had by far the worst inflation of anybody in Europe. There is something in the water in this country that makes it more prone to inflation, and that's the issue. That is what has helped the pound so far this year, is the growing grasp that the Bank of England will have to be more hawkish than hoped.
So, John, you start this interesting, smart, but also funny piece saying, like, no inflation, please. We're British. The British are famous for their idiosyncrasies. Is it harder to be the Bank of England than the Fed right now?
I think so. I mean, there's a lot of pressure on everybody, but in the case of the UK, you do have that much more of an immovable object, in that the inflation numbers plainly are not recovering in the way that makes it easier for them to relent. And I think the labour shortage issue, whether we're going to blame Brexit for it or not, it's very obvious that the labour shortage issue in the UK is very much more serious than more or less anywhere else. While you've got those kinds of imponderables, I don't think it's a coincidence that Andrew Bailey has had to urging everybody, sorry I've let the prices rise so much, could you please not ask for any more pay to cover them, though?
I know, that was awkward.
That was not a great moment.
No.
And I've also called Winnie the Pooh to my aid. I mean, at one point...
That financial wizard, Winnie the Pooh.
Well, yes, it was when Andrew Bailey basically said, we're going to have a recession. It's going to last at least until the end of next year. It's really going to be bad. That very much reminded me of Eeyore the donkey from Winnie the Pooh.
So what I also love, apart from the references to Winnie the Pooh, which get 100% full marks for me, John, is actually you look at charts, and the one that is the most interesting is, of course, wages, as you said, but also dynamics in the labor market.
Yes.
What do people misunderstand about that?
I think when it comes to the labor market, if you look, this is one of my favorite charts that comes from Absolute Strategy, just to credit them. If the CBI have been keeping data on on the proportion of companies that are complaining about labor shortages for about half a century, and if you look at that series over time, it's quite remarkable. The more companies complain that they're having difficulty finding workers, the more inflation will be with a year's lag. And that is, there are really good reasons to question whether the Phillips curve relationship, the idea that there's a trade-off between inflation and unemployment, still holds in quite a number of other countries. There is obviously something about the UK labour market that makes this country much more prone to the risk of a wage price spiral.
Which is why you're also looking at skilled and unskilled labor since 1972. What does the past tell us about the future?
Well, in the 70s, when the UK, as I said earlier, suffered much worse inflation than say the UK, than the US.
Yeah.
The 70s were worse than the 30s in this country. Again, you saw what's happened with that degree of a breakdown with Labour. I think I can remember the winter of discontent in 1979. What is going on at the moment in the public sector doesn't really compare with that at all thus far. But when you have large public sector unions asking for double-digit pay rises and getting quite a lot of public sympathy, which wasn't the case back in 78, 79, that suggests again that there is an incipient wage price spiral here in a way that there isn't elsewhere. So to that extent, you could say
Yes.
that we're idiosyncratic.
I mean, the problem, Christine, is that the markets are saying, look, if you look at the Bank of England, it's a bit of a nightmare, but then you speak to senior politicians, they're like, no, we're not in a worse place than anyone.
Yeah, exactly. A very classic politician tactic, right? You have to kind of present it in the best light possible. But yeah, it is a big headache for the Bank of England for sure, because I think what we also saw from the inflation data this week is that it's being driven not by things that people want, you know, it's not discretionary spending, it's things that people need, the price of egg, vegetables, milk. And so what can the Bank of England really do with trying to rein in inflations via rate hikes when these are staples, these are things that people need, and they're not necessarily within the bank's control. It's due to global trade undercurrents, it's due to weather. So what can rate hikes really do in the face of that? I think that is the problem for the Bank of England.
Christine, thank you so much. As always, Christina Aquino there, and our senior editor for markets and Bloomberg opinion columnist, John Authers. What a treat to have them both in London. Now, coming up as we gear up for the European bank earnings season, we also take a deep dive into the history and uncertain future of Swiss banking after a historic government brokered deal last month. That's next, and this is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
When you think about Switzerland, what do you think of? You think of mountains and skiing, you think of luxury watches, beautiful chocolate, and banking.
Banking is super important in Switzerland, both from a GDP and economy perspective, but also just as a national identity.
People are actually proud of their banks, and a lot of people work in finance.
Well, there's just historically a lot of expertise here when it comes to banking, particularly around banking for those who are rich.
That went quite well up until it didn't.
UBS buying Credit Suisse.
This ends a 166-year run for Credit Suisse.
It was a historic day and a day we hoped would not happen.
UBS now, after the takeover, has provided stability, but it creates a potentially bigger problem in the future.
Swiss banking has built a reputation for reliability, stability, and discretion. Underpinning those attributes are two key policies: secrecy and neutrality.
Secrecy was always a really big selling point for the industry, and it's part of what helped to attract so much money and grow so large.
The neutral status of the country made it a very reliable place for the rich people all over the world.
All things being equal, Swiss banks would not have been able actually to compete with financial centers such as London or Paris that were really at the heart of huge industrial economies. But it did have one edge, the principle of secrecy that dated back to the early 18th century. So when at the start of the 20th century, other European nations started increasing their taxes, Swiss bankers sensed an opportunity. This is an ad published in La Revue Française in 1911 by the Cantonal Bank of Bern. It says that any deposit made by a foreigner who is not resident in Switzerland is actually exempt from paying all Swiss taxes. Plenty of other lenders followed a similar tack. In the years that followed, the two world wars meant that Switzerland's neutrality made it an even more appealing location to deposit your cash without anyone knowing about it.
As Switzerland became more of a player on the international stage, one of the ways that banking developed was to take the status of the stability of the political system and the neutrality of the country to offer a safe haven for people.
At the heart of it all are Credit Suisse and UBS, two banks headquartered just a few hundred yards apart in central Zurich. By the 1970s, global banking had started to change. With increased globalization came more opportunities, but also increased competition and scrutiny.
Over time, people started to demand higher returns. Money laundering became more of an issue in the 80s and into the 90s. Terrorist financing became a really big issue in the early 2000s.
A few major, if historical, scandals started not only to chip away at Switzerland's reputation around this time, but they also drew the attention of international regulatory authorities. As attention focused on Switzerland's banking secrecy in the 1980s, a new business model had begun to emerge. What if the banks could take the vast wealth they were tending for their clients and pair it with an investment bank that could direct the capital into exciting new opportunities, like initial public offerings and deal-making?
Credit Suisse bought first Boston, and then later on Donaldson, Lufkin, and Jenrette, and UBS bought Payne Webber.
The combination of Payne Webber and UBS is a match made in heaven.
That went quite well up until it didn't in about 2007.
The banking sector bore the brunt of the collapse, with shares in Europe's major banks tanking by as much as 9%.
Major financial institutions have teetered on the edge of collapse, and some have failed.
We've had a historic day on Wall Street. Lehman Brothers, the 158-year-old firm, filed for Chapter 11 protection in U.S. bankruptcy court today.
This is when the two banks' paths really diverge.
UBS finds itself in crisis, along with the global financial world, and it has to take a state bailout.
It decided, one, to seriously cut back pretty much everything it did in the sort of the bonds trading, and two, there was a kind of, a reset of the culture. It became out of that a much more humble, much reduced bank.
While UBS was forced to change and take fewer risks, Credit Suisse was not. In fact, it made things worse.
Risk control has obviously many facets, right? One is compliance. Yet at another level for the investment bank, it's about knowing your trading positions, right? Now, one thing they did, they fired a lot of people, senior people, who were watching out for risky trading positions. And instead, they hired a lot of young people who probably did this job for the first time. And that later backfired.
But at the same time, they're still living on that old reputation for stability and responsibility.
What Swiss banks ended up kind of selling to investors, to their private clients, was this old idea of quality and safety and security that they'd also always kind of traded off of. And when things started to go wrong, when banks started to lose more money on behalf of their clients, that really undermines that sort of reputation for safety and soundness.
SVB Bank closed by the regulator.
Stocks Europe 600 then being dragged down by the financial services sector, by the banking sector, down by 2.75%.
Deal done. UBS will buy Credit Suisse for 3 billion Swiss francs.
This is where the government came in with a lifeline of liquidity.
We were speaking very closely with key regulators, notably, or most importantly, the ones in the US and the UK. They were deeply involved, and you have seen today their support for this solution.
Credit Suisse will no longer be an independent company. At the same time, this means a new beginning and huge opportunities ahead for the combined bank and for the Swiss financial center as a whole.
While UBS might be a more trusted brand, a part of the rescue has some questioning whether Switzerland itself is a safe place to invest.
This is Switzerland, bailing in the bondholders.
Typically, bondholders take precedence over shareholders. That means the people who loaned the company cash get their money back before the people that own the business. What happened with Credit Suisse was that people who owned the company's shares received a total of about $3 billion, far less than the company had been worth just days earlier, but a class of debt, known as additional Tier 1 bonds, was completely wiped out to the tune of $17 billion.
They were asking, look, we are losing all our money now. Why would we give you money in the future? And that was another big problem of this merger, because it will make financing for Swiss banks when they want to lend more expensive going forward.
The deal brokers maintained that this was the best of a bunch of bad solutions. There's another reason why the new UBS megabank could be problematic for a small country like Switzerland.
The Swiss state is hoping that by merging these two companies, you get a bit of the best of both worlds. So you get the expertise that's been developed at Credit Suisse in perhaps some of that more innovative stuff, but then also the stability and this sort of stoic culture that UBS has.
UBS now, after the takeover, has provided stability straight away, but it creates a potentially bigger problem in the future.
UBS's balance sheet is now twice the size of the Swiss economy. That's obviously massive. And it begs the question, if UBS were ever to run into trouble, could Switzerland afford to bail them out?
In the last financial crisis, we talked about banks being too big to fail, meaning governments had to bail them out. The new expanded UBS represents a different risk, that the Swiss government just doesn't have enough money to bail it out. Our special report looking there at the history and future of Swiss banking after the government brokered deal to take over Credit Suisse. You can also find it on all of our social platforms. Now, speaking of Credit Suisse, the bank is due to report on Monday, kicking off the European bank earnings season. UBS will also be reporting on Tuesday, along with Santander. Keep it right here on Bloomberg as we bring you the numbers at terminal speed. Now, we did have an interview with Mr. Visco of the European Central Bank. He's governor of Banca d'Italia, saying, look, the ECB must heed contagion risks, and he's also worried about a credit slowdown. He says the ECB should proceed cautiously with any future interest rate hike, as credit growth has been slowing and financial stability risks have been persisting. He spoke to us a very short time ago right here in our headquarters in London. This means, of course, that we'll look forward to what the ECB then has to say next week. We're also getting a lot of breaking news out of the UK. This is Dominic Raab. He is the Deputy Prime Minister, and there had been a lot of speculation about whether he could stay on the job after allegations of him bullying staff really came at the forefront. Breaking news in the last 5 seconds, the UK Deputy Prime Minister, Dominic Raab, has resigned. Coming up, Tesla raises some of its prices after shares slump on first quarter results. We'll discuss that next, and this is Bloomberg.
think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's focus on the UK, and actually also one of the main stories that has rocked the political world here in the UK. The Prime Minister's number two, his Deputy Prime Minister, Dominic Raab, has just resigned. Now, he's resigned from the government after a report investigating bullying allegation against him was handed to the Prime Minister. There has been nothing else that actually people have been talking about in Westminster over the last week or so. Mr. Raab had said he would resign if the inquiry found evidence of bullying, and it is important, he had said, to keep his word. Now, the Transport Secretary had defended him. Complaints into Raab's behavior from several civil servants were investigated by senior lawyer Adam Tolley. So just about 2 minutes ago, we found out that Dominic Raab has resigned. He just wrote this, I think, short letter that was then posted on Twitter saying, "I feel duty-bound to accept the outcome of the inquiry." Now, dozens of people, including Raab himself, gave evidence to the inquiry, which began last November. Some of the questions now going forward is, or could we expect a reshuffle of the government after, this is just yet another scandal that the Prime Minister has to deal with. Just a reminder, we also did get some data out of the UK. April services PMI, better than expected. If you look at the manufacturing, it was actually worse than expected. Coming up, we'll have plenty more Surveillance Early Edition. It'll be Anna here in London and Matt Miller in New York. And this is Bloomberg.
Somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful on society?
Well, I think the first thing you've got to believe in something that you really care about. I've been fortunate that over the course of my career, I've come up with things that have mattered to me, and I've pursued them. You know, the best advice I ever got was from Mike Bloomberg. And he said to me at one point, he said, show me somebody who's never lost, and I'll show you a loser. And I believe that if you believe in something, go after it, take risk. Obviously, they should be smart risks, but they should be around things that you really care about.
So you would see your legacy as being actually target ALS and helping to moderate the impact of ALS, if not curing it.
That's my final legacy. I'm proud of some of the other stuff that I've done as well. Transformation of New York after 9/11. I'm also incredibly proud of a lot of the companies we created at Sidewalk, but I feel like I've done a lot.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
The banking situation is clearly important. It tightens financial conditions. It tightens access to credit.
We're still dealing with the echoes of the crisis, but you're going to slow the economy, hit the banking sector, and make a recession even more likely as the year ticks forward.
Well, I think at the end of the day, with the crisis is too strong a word, and words like that get used a lot. There was a fair amount of disruption for a few weeks there.
Overall, the banks are preparing for the recession if and when it comes, and I think capital generally is moving in the right direction.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Federal Reserve officials are backing another interest rate increase. At the same time, they're watching the fallout from strains in the banking system. Russian arms sales to India grind to a halt. Both countries are trying to find a way for payments to be transferred without violating U.S. sanctions. And Elon Musk's wild ride. In one day, one of his SpaceX rockets exploded, Tesla shares plunged, and his fortune shrank by almost $13 billion. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, here in London, where I am, everybody distracted, of course, by this latest political news flow surrounding the resignation of the Deputy Prime Minister. There was a report into whether he was bullying his staff. And so that's certainly the domestic consideration. Back to the global news agenda then and the global market moves. We see everything related to commodities under a little bit of pressure today.
Yeah, absolutely. And we're going to check on iron ore in just a second. But we also see oil, for example, although not moving very much, at a pretty low level, regardless of the fact that we had stockpiles come in weaker than expected, and we had obviously that surprise cut a couple of weeks ago by OPEC Plus. It doesn't seem to be helping the price rise much higher. Take a look at S&P futures right now. We're just up about 0.04 of 1%, so unchanged, and we've moved down because futures were higher just 2 minutes ago when I was sitting at my desk. So they're coming down a little bit. Yields are coming down a little bit as well. On the 10-year, you can see 352.99. We had gone up to 360 to start this week, and now we're coming off a little bit. Here's NYMEX crude. I was just talking about the fact that we're not moved very much, only up a nickel right now, but still holding at a pretty low level considering the fact that we've seen drawdowns in terms of stockpiles and we've seen cuts in terms of announced production from OPEC Plus. Nonetheless, that price, had been $83 last week, and now we're looking at 77. Bitcoin coming off again today, another $128 down to 28,000. 82. So we're looking at a decent drop below the 30,000 level that we pierced earlier this week. Take a look at what's going on in Asia. We had some big gains in terms of stock, or some big losses in terms of stocks there. The broader MSCI Asia Pacific down only 0.75%, but the Hang Seng down more than 1.5%. And when you look elsewhere in China, especially on the mainland, also 2% drop there. Iron ore is the commodity that I was talking about under pressure here, down more than 6% right now. So concerns about the economy really heading into a recession maybe globally, and concerns about the economy in China putting some pressure on that price. And then you can see that the US dollar here is a little bit weaker against the yen. So maybe some money going into the Japanese yen is a bit of a safe haven, although we never know anymore whether the dollar is a safe haven compared to the yen. But right now you can buy 133.78. What do you see going on in Europe, Anna?
Yeah, I saw some FX traders being cited on that very point, Matt, earlier, around the yen gaining on geopolitical concerns between the US and China. That's the sort of overhang of that geopolitics story of yesterday. Let's have a look at where we are on Europe then, Matt, to your question. And we're kind of mixed across the continent of Europe. The UK market outperforms a little bit, which is kind of surprising given the underperformance of the basic resources sector, the mining sector under pressure. Let's have a look at how that's playing out for the basic resource sector. It's by far and away the worst performing sector. You showed the iron ore price. Oil prices retreating a little bit back down to those levels that we saw at the time that OPEC Plus cut production, Matt. And so as a result, basic resources stocks down by 2.4%. EssilorLuxottica going against the tide today. This is the maker of Oakley sunglasses, Ray-Bans. That stock up by just over 7%. Americans buying sunglasses. Clearly the future must seem bright enough to somebody. This is the euro, down 0.1%. We've had really interesting data out from the Eurozone today. The composite parts and also the whole telling pretty much the same story. The composite reading is suggesting that the economy picked up pace, picked up momentum, there was a better performance, but it's all in services and it's certainly not in manufacturing. We saw the same in the UK data, but really interesting dual track running in the Eurozone economy now, with manufacturing really sluggish, in recession essentially, and the services side performing really strongly. On the pound, a lot to mention. There's the politics, of course, that's not really weighing in on what's going on here. The pound was down by 0.3% as a result of the data. We got retail sales data that was lackluster. We got consumer confidence that's actually a bit more forward-looking, that looked pretty positive, but all in all, the market choosing to sell off. And we got the PMI data out of the UK, incidentally, Matt, which told us the same story. I guess the big takeaway we get from that politics story that we mentioned at the top of the program about the resignation of the Deputy Prime Minister, and more proof that the Sunak administration is not the Johnson administration, and perhaps that will matter at the margin to some.
Oh, and the fact that we take bullying very seriously, or you do it certainly, in the UK. Let's get to the central bank story. Fed officials are backing another interest rate increase. At the same time, they're monitoring the economic fallout from stresses on the banking system. Cleveland Fed President Loretta Mester spoke yesterday.
I anticipate that monetary policy will need to move somewhat further into restrictive territory this year, with the Fed funds rate moving above 5%, and the real Fed funds rate staying in positive territory for some time. Now, precisely how much higher the Fed funds rate will need to go from here, and for how long policy will need to remain restrictive, will depend on economic and financial developments.
Bloomberg's Valerie Teitel joins us now for more on the Fed speak that we're hearing. You know, a lot more speakers up until the blackout period comes. And also, Valerie, you can tell us how important these PMIs are that we're waiting for in the U.S. today.
Yeah, sure, Matt. The Fed speakers yesterday are all finally singing from the same hymn sheet, all kind of backing another hike to come in May. We're hearing very little about a case for a pause like we heard last week from Daly and from Goolsbee. Harker saying rates are pretty close to where they need to be. Bostic saying he favors one more hike and a pause. And then Mester, which we heard from right there, saying rates are likely to go higher than 5%. We're at 5% now, so that's implying one more hike. A lot of this didn't come to a surprise to much of the markets. The front-end pricing didn't change very much after this Fed speak we got yesterday. We are pricing in a terminal rate of 5.25 and 100 basis points of cuts until the end of the year.
Okay, and now we go into blackout, and so we don't hear much more from Fed officials, do we, in the coming trading sessions. Let's talk about some of the data we got out earlier on. We get US PMIs later. We've already got the UK and the EU side of things. Really uneven between manufacturing and services.
Yeah, that's right, especially for the UK. It's showing, quite a positive sign that the UK economy is holding up under the weight of rate increases. The beat in services was notable. It hit a one-year high and also drove some job creation. It's likely to strengthen some further the case for further rate increases from the Bank of England. The story is quite similar when it comes to the Eurozone as well. The composite rose to an 11th month high. It's showing an even better picture for the Eurozone economy than the UK as it gains further momentum. The key thing here is that the divergence from manufacturing and services, it's the most diverged since 2009. Now, some are noting that the miss in manufacturing is mostly due to the protests that we've had in France recently, but the divergence is notable. Now, there was some more underlying data we got from the PMIs that showed that price pressures are moderating, but they are still quite elevated. It's likely going to keep the ECB on its toes when it comes to staying on the hawkish side for now. And the currency did like it. It was down a bit more earlier before the data, so it did support the euro. Sterling, however, is still suffering from a bit of losses. That was from the weak retail sales we got earlier out this morning.
Yeah, that was a few hours ago, wasn't it? And it hit the pound. Valerie, thank you very much. Bloomberg's Valerie Teisel with a look at some of the important data of today. Back to the breaking news that we mentioned at the top of the show. The UK Deputy Prime Minister Dominic Raab has resigned after being the subject of a probe into whether he bullied his staff. Rosalind Matheson's Bloomberg's senior executive editor for government joins us now. We'll start with this and then widen the conversation into other geopolitics, which I know is of interest today, Ros. I mean, what do you take away from this? We knew this report was coming. It's been since November they started working on it. Is this another example of Prime Minister Sunak trying to show that this is a different administration to ones that have gone before?
Well, certainly that seems to have been the call that he's made, because he was clearly wrestling with his decision for several days what to do, because of course Dominic Raab is a key backer of his and has been for some time. And Dominic Raab, of course, was insistent that he'd done nothing wrong against all these allegations made against him. So in the end, he's landed on the side of obviously asking Dominic Raab to leave, and Raab now resigning. And that's sort of trying to send that message, as you say, that he is indeed a very different kind of administration after some pretty chaotic administrations before him under the Tories, and that he's very much focused on sort of a cleaner administration, a tighter administration. He's been showing that in other ways, of course, also trying to sort of renew the relationship more so with Europe, for example, trying to clear house on Brexit. He's clearly trying to get all these things in the past so that he can focus on his agenda going forward. So very much he will face some blowback within the Tories for this decision, but he's clearly taken the call that he wants to put it all behind the Tories and move forward.
I want to ask about the Biden administration, Roz, because we've been talking a lot over the last 24 hours about sanctions that it wants to put in place in dealing with China. Of course, the sanctions that we have in place on Russia seem to be working. It looks like India has decided it can't figure out a payment mechanism to buy Russian arms, and therefore $2 billion in deals is off.
Well, that's the interesting thing, because of course India has been a long-term buyer of weapons from Russia for many, many years, but Russia often lets them extend the credit. They don't call in the bills and they stack up, and there's no rush to sort of demand payment. So what this tells us is that Russia wants payment now, and it really needs that money to fund its economy and its wartime machine, but also it puts India in a difficult spot, because how on earth do they make these payments? They can't make them in US dollars. India doesn't want rubles, because no one really wants rubles right now, but Russia also doesn't want rupees. So how can they facilitate this payment? So that's the sort of the pickle really that India is in, because Russia is clearly now saying to Delhi, we want you to get up to speed on your contract, so we're going to stop sending you the kind of weapons that you in fact need also, because India wants these weapons from Russia to sort of provide a deterrent, not just against China, but also for Pakistan. It's got a number of issues on its border areas, and it needs these weapons still coming in.
Ross, thanks so much. Thanks for the update. Rosalind Matheson covering a number of geopolitical themes for us this morning. Now let's get on to corporate news. A U-turn from Tesla. The EV maker has increased the prices of the Model S and the Model X vehicle in the United States. It comes after the company's shares fell following first quarter earnings. A slump driven by worries over recent cuts to its car prices. Bloomberg's Alex Webb joins us now. Alex, now, forgive me for being a little confused here. I thought a day ago we heard from Elon Musk and he was talking about how they could cut prices further. What do I not understand about this story?
these are not models that sell huge volumes. I think that's the key thing to remember here. They're looking at the Model S and the Model X. These are, models that sell sort of in the order of 50,000 or so, maybe a little bit more units a piece. So it's, a good thing to tell the market, we're not cutting all the model prices, particularly given the fear that investors have about commodification. The reason they invest in Tesla, a lot of them anyway, is because the growth is really good, but it's increasingly profitable growth, or sort of has been. This isn't necessarily massively changing that dynamic. If we're not looking at the Model 3, we're not looking at, which is the kind of the big selling model. So it is a change. It's not a massive one.
Right. I feel like they're going to change prices every day so that we talk about Tesla at the top of every newscast. We should be talking about SpaceX because Musk had said that even clearing the launch pad would be a success. They did that and more yesterday, but of course his Starship rocket ended up exploding, or they pushed the self-destruct button at like 30 miles above the Earth's surface. Talk to us about what this means for his ambitions to take humans to the moon and then later to Mars.
It certainly seems to set it back a fair amount. NASA has said that it hopes to be able to use Starship to land people on the moon in 2025. Now, the process to do that is vastly complicated. They're talking about sending a ship up into Earth's orbit, which will carry the fuel. Then you have to refuel. You have to fuel that thing up, which might take 12 Starships to do. You then have a ship that goes and docks with it in order that people can then go to the moon. There's so much needs to happen between now and the moon landing. And the fact that they haven't actually yet managed to get the rocket into orbit certainly suggests that 2025 is vastly ambitious.
Okay, Alex, thanks very much for the update.
Yeah, maybe they'll have to dust off an old Saturn, because those worked. Let's take a look at some of the stocks we're watching in pre-market trading in the U.S. That was a sarcastic remark, obviously. I think SpaceX has made incredible strides, and it's a story to watch. Tesla, on the other hand, is one that seems a little bit wishy-washy in terms of pricing, as you pointed out. They've cut prices 6 times, but as Alex was telling us, those were on the really high volume models, the Model 3 and the Model Y. They're raising prices on the S and the X. They're already expensive, and they're getting a little bit more expensive. So the shares are coming back up a little bit, 1.5% in the pre-market. We'll see what happens when the trade kicks off, cash trade kicks off in a few hours from now. BuzzFeed is shutting down its news operations completely. So this stock coming up a little bit in the pre-market, but of course it's a penny stock trading at 81 cents with an 8% gain. We also heard that Business Insider, I think it might just be called Insider now, is cutting staff about 10%. So not great news for professional journalism across the U.S. There's a company called Wish, which is kind of like an auction website that sells a lot of different goods, a wide assortment of goods. It's rising in the pre-market 20%, so gaining by a fifth after announcing a $50 million share repurchase program. It's not a huge company, so that's a big amount in terms of the shares out, and as a result, you see a big pop this morning in the pre-market trade. Anna?
Coming up on the program then, Matt, we'll talk to Kokou Agbubloa, Societe Generale's global head of economics, cross-asset and quant research. What does he make of that really divergent picture within Europe today between manufacturing and the services side of these economies? We'll also talk to Norway's sovereign wealth fund. It returned $84 billion in the first quarter. We will speak with the deputy CEO, Trond Grand. That conversation coming up later this hour. Plus, Brian Moynihan says banks are in good shape. The Bank of America CEO spoke with Bloomberg's David Weston yesterday.
The good news is the basic industry has reported good earnings across the board. Deposits have come down, but that's intended by the Fed taking money out of the system. It's got to come out of somewhere. Banking system is what they want to do to, frankly, make credit tighter and help slow down the economy. So that's gone on.
what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Welcome back to Bloomberg Surveillance. I'm Matt Miller here in New York with Anna Edwards in London, and we are looking at an incredibly tight trading range in terms of stocks. You may have noticed that we've only been going up or down just a little bit, and that puts us on track for the tightest monthly range that we've seen in terms of the trading band on the S&P 500 since 2017. What happened to all of the volatility? Well, it could come back today as options expire and market makers are said to be long gamma, whatever that means. Joining us now is Justina Lee, Bloomberg Markets reporter, to explain, hopefully not the Greeks, Justina, but just what could happen at the options expiry today.
Yeah, I don't know if I'm about to become the first person to talk about the option Greeks on Bloomberg TV, but I can try to take up that challenge. I mean, what's happening today is a lot of options are expiring, and the reason that matters is because it affects the option market makers' positioning, because they're trying to hedge their positions as well, and their hedging every day has an impact on the market. And all along, recently, market makers have been long gamma, and what that means is that they're usually hedging in the opposite direction of the market. So if the S&P 500 is up, they're selling it, and vice versa, and that has had an effect on realized volatility, as you talked about. But I think at the same time, it's pretty incredible, and it just shows that currently traders are in this state where they're not too worried about credit crunch or recession just yet, but at the same time, they're also not that worried about Fed tightening either.
Elsewhere in the markets then, Justina, we're also focused on commodities. Matt mentioned at the top of the program the big drop in iron ore prices, all being put down to a sort of lackluster Chinese demand story. What's happening here?
Yeah, it's pretty interesting because we have seen pretty good Chinese data lately. And of course, the narrative all along has been that Chinese demand will pick up, as it kind of reemerges from the COVID lockdown. And I think so it's kind of interesting that we are seeing not that strong Chinese demand, but at the same time, obviously, we also have to consider that against supplies, and it seems like supply has been pretty ample relative to that demand. And we've also had the Chinese government, grumbling a little bit about iron prices as well.
Okay, so maybe there's a supply side too. Thanks very much, Justina. Bloomberg's Justina Lee with the latest on markets. And you can get market analysis on the Markets Live blog. That's where you'll find it on the Bloomberg terminal. MLIV Go is the function to use. This is Bloomberg.
what's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Now keeping you up to date with the news from around the world, here's the first word. President Biden will crack down on U.S. investment in key parts of China's economy. Bloomberg has learned that he'll sign an executive order in the coming weeks that will limit investing in Chinese semiconductors, artificial intelligence, and quantum computing. The president is hoping to get the backing of its of the U.S.'s G7 partners. Meanwhile, President Biden may formally launch his re-election campaign as early as next week. The president's aides have planned for the possibility of making a video announcement to coincide with the anniversary of his previous campaign launch. He has been signaling that he intends to seek a second term next year for quite a long time, making it somewhat of an open secret. In Canada, police are investigating an airport heist that may have resulted in thieves getting away with millions of dollars worth of gold and other valuables. It took place at Toronto's International Airport, the country's busiest. Police say a container with more than $14 million in gold and other items was taken from an airport holding area. An exciting story, Anna.
Coming up on the program, we'll get back to the markets. We'll talk to Coco Agbubloa, Societe Generale's Global Head of Economics, Cross-Asset and Quant Research. This is Bloomberg.
this. Can I ask my landlord for a rent cut in the next couple months? Like, is that reasonable?
Well, I guess it depends when you signed your lease, Joe. It sounds like you got kind of one of those pandemic deals that, particularly in New York City, where rents actually fell really sharply in that first year of the pandemic. So we are really seeing the market having turned a corner a little bit over these past few months. Prices have been coming down for 4 straight months now in our national rent index. But, if you're still paying that late 2020 level, then you might not necessarily be eligible for a discount at this point.
Good point. All right, I have another question, which is like, so I have 2 kids, but unlike other people, I actually am cool and I don't want to move to the suburbs. Like,
this episode is just Joe taking like advice on handling his rent.
I just want to point out, I really like my landlord.
You love your landlord?
She's very attentive. We have a very good relationship. So even though I started the episode saying I was anxious, if she is listening to this, I hope she hears that I really enjoy where we live and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rating World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Federal Reserve officials are backing another interest rate increase. At the same time, they're watching the fallout from strains in the banking system. The British Prime Minister Rishi Sunak's deputy Dominic Raab steps down. An investigation into bullying complaints has been ongoing. And Elon Musk's wild ride. In one day, one of his SpaceX rockets exploded, Tesla shares plunged, and his fortune shrank by almost $13 billion. I'm Anna Edwards in London with Matt Miller in New York. We've got UK politics. We've mentioned that a couple of times. Matt, there's been really interesting data out of Europe. In the face of all of that, US futures do pretty much nothing.
Yeah, doing a lot of nothing in a month that, as we were talking about before, has seen the tightest trading range since 2017. So right now, absolutely unchanged on the S&P 500. We dropped yesterday to a level of around 41.29. We do see a reversal in the 10-year yield. It had been coming down as investors bought the bonds. Now it's rising as investors sell the bonds, but also not a lot of movement there. Right now at 353.37. NYMEX crude also unchanged. Look, we're waiting for an options expiry today, as Justina Lee was telling us earlier, that could actually move markets in one direction or the other. We could see a little bit of volatility come back into these markets, but as of yet, we're really not seeing it. Bitcoin continues to fall, second day in a row of drops. Right now, it's off another $180 to 28,000, but still about double the level that we saw at the bottom after the explosion of FTX. In terms of movers, we see Tesla increasing prices of the Model X and the Model S. Yesterday, it was marking down prices of the Model 3 and the Model Y. They're very different segments for the car maker. Nonetheless, it looks like investors sell the stock when they cut the price and buy the stock when they raise the price. In less funny news, BuzzFeed has shut down completely its news operation. So bad news for professional journalism across the country. Business Insider is also cutting about 10% of its staff. A lot of cost cutting going into what some say is going to be a recession, although we haven't really seen the job losses or the growth slowdown yet. Maybe this is another sign adding to portending that the recession is on the way. And then Context Logic. The ticker is Wish because it owns that website, which is kind of an auction website that sells a broad array of goods. Those shares are up 21% after announcing a share buyback program of just $50 million. So I guess every little helps, Anna. What do you see in Europe?
Yes, European stocks still gaining, but not really by much, up by just 1/10%. So the stock 600 making an incredibly modest gain as we head towards the end of the European trading session. It's, well, 10:30 here, so not the end of the week, I was meaning. Basic resources is certainly a sector that weighs on sentiment today. Matt was talking about the iron ore price earlier on. That is under pressure. Lackluster Chinese demand seems to be the driver there. And as a result, we see the basic resource sectors, all those mining stocks listed in London, under pressure today. EssilorLuxottica is the maker of eyewear, the Oakley brand, the Ray-Ban brand. It has both of those in its stable. And that stock is up by 6.6%, so really outperforming the market on the back of better sales than expected out of the United States. And the pound responding to so much data. We had a mixed picture. Well, overall, the composite PMI doing well, but there was a real divergence between poor manufacturing and good services data. We saw that across Europe. That was the story in the Eurozone broadly as well. But we also had lots of other data out on the UK. A brighter look when it comes to consumer confidence, a weaker look when it comes to retail sales. So all of that has added up to pound weakness this morning, Matt.
All right, we're watching the FX pairs closely today. Joining us now is Koku Agbubloa, SocGen Global Head of Economics, Cross-Asset, and Quant Research. And Koku, let me first get your take on what's going on over there. Dominic Raab resigning. Is this government strengthening itself, or are you concerned that they're losing key players?
Well, it clearly is going to bring more instability and volatility when it comes to government policy. But that being said, I think the bigger picture that markets is really focusing on is whether we'll have this recession or not, because the UK has managed to escape a recession, and most of the forecasts are pointing to a pretty resilient economy, and that's a lot of the concern and sort of puzzled faces that a lot of investors are facing right now.
Yeah, Koku, what do you make of all of those moving parts and the way they don't all add up? Because we got, on the same day, consumer confidence that looked pretty bright, retail sales that look pretty weak. What do you take away from just that set of data, but also the overall picture in the UK about where we're heading?
Absolutely. I think it is a phenomenon that is pretty much widespread, and it's something that was mentioned in the press. It is essentially greedflation, or the ability of companies to pass on sort of higher prices, and sometimes to protect their profit margins, but also in cases higher than what their input costs would dictate. And this has led to a situation where profit margin have been pretty stable. Consumers were able to take those higher prices because you have an expectation that prices across the board are rising. And then in addition to that, you have excess savings that have been built on consumer balance sheet. And last but not least, government policies to shield lower income households. So you have a situation where despite significant tightening by monetary policy, it is as if corporates have built natural immunity against inflation. And this leads to a situation where they are not under big pressure to cut their workforce. In addition to that, we used to have demand being constrained, and that's why we did a lot of QE historically, because supply was higher than demand. Today, we are in a situation where it is supply that is constrained, and we have excess demand because of all the fiscal stimulus over time and sort of strong profit margins. And this creates a situation where we might have to raise interest rate by more to destroy enough demand to get inflation back in track.
Okay, and where does that leave the Eurozone story, Koku? Your reference there to greedflation in the UK context, but maybe a little broader as well. But where does that leave the Eurozone? Because we've heard a lot of people suggesting that the Eurozone is going to keep hiking longer than the Fed does. I wonder where you think that takes us.
Very good point. And I think that the point I mentioned in the UK is actually very specific to Europe as well, because we have a situation of tight supply and excess demand. And this is why we don't see the Eurozone going into a recession. And the Fed has done quite a lot in tightening monetary policy. I think the ECB is behind the curve, and they will have to tighten even further, because a lot of the data we're looking at are pointing to a pretty strong and resilient economy, and particularly a pretty strong core inflation driven by wage pressures. So we see peak interest rate in the Eurozone at roughly 4%, and there's risk of upside to that. And in the US, we see peak interest rate at 5 to 5.25%.
Let's listen for a moment to, speaking of the ECB, Bank of Italy Governor Ignazio Visco talking with Francine Lacqua a little bit earlier.
We have to be, I think, cautious. It does not mean that we stop, or it means that we decide meeting by meeting on the basis of the information that we get. Wages and profits. And this is what we are looking at, whether the wages will make up and whether profit margins will remain unchanged.
Two interesting things here, Koku. First off, on wages, at least here in the U.S., they outpaced inflation, so that's a concern for the Fed. A second issue is profits, and that comes to earnings season, right? How are these two things comparing, or how are they different in the U.S. and Europe in terms of the wage growth and the earnings picture?
Yes, this is a very good point. I think there's a generalized lack of supply of goods and services, but also labor. And in the U.S., it's the issue around the Great Resignation post COVID-19, and that's led to a sort of tight labor market where you had sort of 2 job offers for every unemployed. And in Europe, we see a similar situation of tight labor markets. But the point on profit margin is a very interesting one, because whilst profit margin are going to get negatively impacted by wage inflation and wage pressures, but more so in the US than in Europe, although Europe also has an issue with wage inflation, companies have been able to pass on roughly the level of the CPI, 8 to 10% increase in prices across the board. And that has more than offset the drop in volume and also the input cost inflation leading from commodities, but also wages. So you get to a situation where profit margins are roughly stable and earnings are going up, despite this massive sort of cost of living crisis. And this means that you need to put even more tightening and more pressure for on demand and on businesses. And to my point earlier, it is as if corporates have built a sort of natural immunity against inflation, and you need tighter interest rates for that to affect businesses and slow demand and increase unemployment.
That's really interesting, Koku, and something we'll keep an eye on as we go further through earnings season and as we watch consumer strength and weakness. What are the best opportunities you're looking at the moment? Do any of them feature China? We were talking about commodities trading weaker today as a result of some lackluster demand out of China. We got data that wasn't too bad on China, but the geopolitics plays against it. I wonder what your perspective is on opportunities in China at the moment.
Yes, we're actually pretty constructive on China. I think they've done something that was quite incredible. It's going to herd immunity in a record time, sort of with hundreds of millions of people getting COVID when they ended the zero tolerance policy. So we see excess savings and excess deposits in the range of 9 to 10% in China, which was accumulated through the zero tolerance COVID policy. So we see a pickup in demand, and sectors that are likely to benefit are tourism, luxury goods, consumer-related spending sectors are the ones to favor. And there's also read across to Europe, particularly sectors that are exporting luxury goods, for example, are some of the best performing sectors so far. So the other very interesting theme is really around keeping a balanced equity bond portfolio, because eventually there will be a sort of slowdown and bonds would benefit. And then sectors around energy transition, greenflations, where you have pricing power, but a lot of investment needed. So to conclude, and to quote Winston Churchill, who said about the World War II after the Battle of Alamein in 1942, after the major defeat by Nazi Germany, the battle against inflation, this is not the end. It's not even the beginning of the end. It is maybe the end of the beginning, particularly when it comes to medium to long-term inflation around green inflation and the energy transition.
Okay. Koku, thank you very much. Thanks for taking us in that direction. Koku Agbeblua of Societe Generale with his thoughts on greedflation, on greenflation, and the China drivers and opportunities right now. Coming up on the program, Norway Sovereign Wealth Fund. We'll be speaking to them. They've returned $84 billion in the first quarter. We'll speak with the Deputy CEO of the fund, Trond Grant. This is Bloomberg.
as governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, Norway's $1.4 trillion sovereign wealth fund returned $84 billion in the first quarter after markets continued to rally despite jitters over banks. Joining us now is Trond Grand, Deputy CEO of Norway's Sovereign Wealth Fund. And before we get to the question on the banks and the macro discussion, Trond, I want you to just wrap up the quarter and the performance for us. Is it good enough for you? Are you happy with the results?
Well, thanks for having me on. We are really, really happy with this. Well, it's just one quarter, right? And we're a very long-term investor, so be that as it may. But we really saw after a weak year for us last year, we were really happy to see first quarter bounce back. We even saw it in the fourth quarter last year. So 5.9% as we measure our returns is a really strong result. It's up there almost top 10 of our quarters over 27 years. And in monetary terms, it's the second best quarter we ever had.
That's a nominal result, right? Because inflation has been pretty strong lately, so real results are a little bit more painful. What is your view on the inflation picture right now and the central bank path going forward?
Yeah, well, we don't. We sit within a central bank, right? So we're a little bit cautious of our opinions around that. But obviously, inflation is not good for an investor, and so we have been concerned about this. And now, of course, central banks around the world have taken arguably drastic measures to address that. And that, of course, you know, is again good for a very long-term investor with higher interest rates, because it kind of gives a floor to our returns going forward. But in the meantime, it's of course painful, and we saw that last year with the negative return both on our equities and bonds, and that's has been the opposite this quarter.
Trond, I know that your CEO has recently talked about the exposure you had to SVB. I don't know if you can give us any numbers around what damage that did to you, even though the quarter, as you say, turned out in a way that you're happy with. He also was talking about how it's important to put resources into finding rotten apples, so businesses that you don't want to have exposure to. I wonder what that means. How do you go about finding those rotten apples?
Yeah, well, you know, our starting point is that we are essentially a very broadly diversified investor. We have more than 9,000 equity holdings, and we stay pretty close to a starting point, which is our benchmark index that's given to us. Now, we have also undertaken quite significant efforts over the last, say, actually 10 years, and intensified over the last years, to make sure that, you know, even though we are largely invested as broadly as the index, there are certain companies with certain practices that just doesn't make sense for us to be exposed to. So we have great monitoring and trying to, take out those, call them rotten apples if you want. Now, particularly or specifically with the SVB, we weren't, in any shape or form harmed by that turmoil, nor specifically in SVB, nor in the regional banks in the U.S. So no, we're taking measures to make sure that we can see if we can take out some of these less good companies.
Okay. And clearly we saw all of the turmoil around the collapse and takeover of Credit Suisse as well, Trond, so bringing it back to Europe. But broadly, around the banking sector, has this changed your view on banking or the level of detail you want to see from banks that you have exposure to? What have you taken away from this particular episode?
No, I think, I joined the fund 15 years ago, just before the financial crisis, and a lot of things were put in place, regulatory requirements and so forth, that I think makes for a more robust financial system as we have it today. And I think what we saw wasn't really a credit event in any shape or form. It was more liquidity and poor risk management, to be honest. And of course, you might need to expect to see that when you have such rapidly and forcefully increasing interest rates. Not everybody is prepared for that.
Trond, can I go back to the SVB issue and just ask, because our reporting shows you had $160 million equity stake in SVB just before the collapse, about $100 million in bonds. I get that this is small potatoes compared to the amount of assets under management you have, but when you say your portfolio wasn't harmed by SVB, do you mean that you're going to recover that investment?
No, I mean, it's a little bit of a broader picture, right? So you had SVB in particular, but there were other banks as well. So, we do active management of our portfolio. And what I'm saying is that, from that, if you kind of want to ring fence it to the regional banks in the US, we fared pretty well through that turmoil. That's what I'm saying.
Yeah, I think also your business has been talking about getting more exposure to private equity. I understand at the moment you have stocks, bonds, real estate, renewables assets, and private equity is a bit of a talking point. What is it about private equity do you want to get exposure to? And would that be only listed private equity because of the transparency that would come with that?
Well, yes, it would not be only listed private equity. That would kind of maybe a little bit defeat the purpose. So this is the way it works here in our fund is that we take great caution to evaluate how we best can position the fund for the really, really long term. And what we've seen are some developments in the listed markets where fewer companies choose to list. The ones that choose to list, they're typically larger, older, meaning that more of the value creation has happened before it comes to the exchange. And so we're seeing that trend, and we believe that is a long-term, more kind of trend to continue. And hence, we think it makes a lot of sense for a long-term fund to also capture some of that value creation. I mean, and then we're talking unlisted, and many are concerned about the illiquidity, but this fund is certainly well positioned to stomach illiquidity.
Trond, speaking of illiquidity, what is your view on the risk posed by commercial real estate, especially, the need to refinance, especially here in the U.S.? I have investors writing in all the time asking about, how worried they should be when it comes to the CRE maturity wall of $500 billion a year. It sounds very scary. What's your take?
We don't have a particular view on that. I mean, obviously, the good thing is that everybody's aware of this, right? And so I think it's also, you have to remember it's in both the interest, I believe, of the banks and the borrowers to find good solutions, right? Nobody is better off if something bad happens. So I think obviously it's a big challenge, but I think it's something that can be worked through.
It just strikes me that these are some of the rotten apples you may be finding when you sort through your barrel. Trond, great to have you on the program. Thank you so much for joining us. Trond Grand there, Deputy CEO of Norway's gigantic sovereign wealth fund. Now, speaking of big funds, hedge funds are raising more money at levels not seen since before the pandemic. And the 2024 crop could include one of the largest startups in years. Joining us now for more is Bloomberg's Hema Parmar. She wrote the story on the Bloomberg Terminal this morning on this subject. Hema, thanks so much for coming on so early in the morning. Talk to us about some of these launches, some of them incredibly highly anticipated and raising, big dollar amounts.
Yes, so we're seeing a number of multi-strategy fund launches this year. Two of them run by ex-Citadel executives. One of them expected to launch with about $2 billion later this year, another one with about 1.7. So these are pretty sizable launches in this environment, both of those multi-strategy, multi-manager funds. And then there's Bobby Jane over at Millennium, who's considering launching a hedge fund next year. And we hear that if he does go ahead with those plans, he could be one of the biggest launches that we've seen in years.
Hema, good morning. What does this tell us then, that these funds are able to launch in such a sizable way?
Yeah, so a number of the sizable launches that we're expecting this year are people who are coming from very notable shops who've had tenure and spent many years there. If you look at Mala Gorankar over at Lone Pine, who's launching her fund, she was there for 23 years. So that goes a really long way in building the trust and the confidence of allocators that they can continue the track record that they bring from their old shops. And I think also, you're seeing potentially some interest in putting money to work to capture the volatility that we're seeing in the market these days.
We certainly talked to a number of investors who might be worried about higher interest rates or recession in the US and have many reasons to be maybe cautious in the second half of this year. So does that stand in contrast to the size and scope of the fundraisings we're seeing here? What's going on?
Yes, no, so all of that said, it's still a very difficult fundraising environment if you compare now to 5 years ago. So while there may be some interesting opportunities to put money to work, you are still seeing overwhelmingly most of the money coming into the industry going to the very big name funds that have already been around for a very long time. And so that spells competition for every dollar that you need to raise. Add to the fact that in many pensions, endowments, foundations, they may be already overexposed to private equity, and so may not have as much capital to deploy into the market. And there's obviously concerns with rates and the environment in general. So definitely still challenging compared to, say, a decade ago.
What do the structures look like now? I've been in this business for 20 years, and I'm hearing terms that I have never heard before. Pods, for example, seem to be the most popular thing right now, which is, I guess, another term for multi-strategy funds.
Correct, yes. Little
multi-manager.
Pods, multi-manager, exactly, yes. So that's certainly a very popular strategy. But to do that sort of fund, you need to be very big in size. You do need to be at least $1 billion or so. But as for the funds that are smaller and emerging, they are thinking about fees and maybe lowering them down, starting a fund with a leaner team to be cost effective, being more work from home friendly for your talent, being more open to SMAs, separately managed accounts, which are increasingly popular, and thinking about outsourcing parts of your business. So these are the newer ways of, or what you might need to really consider to launch a fund nowadays compared to many years ago.
All right, Hema, great to get you on the program. Thanks so much for joining us. Hema Parmar, they are talking to us about hedge funds. That's it for Early Edition. Bloomberg Surveillance, the OG, is up next. They're going to have Priya Misra on the program of TD Securities, among others, as we await the PMI data. This is Bloomberg. Happy Friday.
most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time you go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is a frustrating market for both bulls and bears.
We're still dealing with the echoes of the crisis, which are going to slow the economy, hit the banking sector, and make a recession even more likely as the year ticks forward.
We haven't really seen U.S. growth deteriorate that much yet.
I think there's still a lot of lingering concerns over credit tightening.
We have to keep in mind that tightening access to credit and tightening financial conditions is exactly what the Fed has been trying to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Let's get you to the weekend, live from New York City. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz. I'm Jonathan Ferro. TK is going to take a long weekend. Equity futures on the S&P 500, totally unchanged. A little bit later this morning, we need to discuss this story. President Biden could be looking at formally announcing his re-election campaign as early as next week. Exclusive reporting from the team here at Bloomberg. We'll catch up with Anne-Marie a little bit later. We need to catch up on this market as well. Tons of Fed speak, lots of earnings. This line from Michael Hartnett of Bank of America this morning. To end the week, Lisa, sell the last rate hike. That's his mantra. He's been talking about it for a number of months now.
The bears are consistent, even with a lot of hate, even with not being necessarily right for a while. The bears are consistent that they are still bearish and that, frankly, the data just confirms it. And if the market's not confirming it, well, they're going to catch up because it's only a matter of time.
Easing of financial conditions premature. The view from UniCredit. We've heard so much like this from UniCredit, from Bank of America, from JP Morgan, Marko Kolanovic, from Mike Wilson over at Morgan Stanley. They have not changed their view over the last month.
If you look at the earnings, it confirms what they're saying. That's the issue, is that the fundamental story actually is very much in line with the bearish prognostications. If you take a look at earnings coming in below expectations, yesterday we saw actually a tick up in the usage of the emergency loan programs from the Federal Reserve, catering to some of these banks. You know, on one hand, nothing massive. On the other hand, a signal that all is not clear. We are not completely out of the woods at a time when it's clear the economy is slowing, albeit alongside inflation.
Seen some signs of stability in the banking sector. I'm with you on the latest data, a little bit unnerving, but overall more signs of stability than not. Profitability problems, though, are going to persist, we imagine, for some of the smaller banks, Lisa. That's going to lead potentially to tighter financial conditions. And for the Federal Reserve, I still don't think the Fed really have the answers they want or need beyond May. And that's the problem, beyond May. They can't give you anything beyond next month.
So yesterday we heard a slew of Fed speak. You did a fantastic nursery rhyme about it. I do think there was a very cohesive message for the first time, which is one and done. They're going to hike one more time and they're going to pause. And that seems like the consensus right now in the Federal Reserve. Now the issue for markets is how long are you going to pause for? Basically, are you going to keep it there for a longer period of time, or are you going to keep cutting in the face of some pretty significantly deteriorating information? Yesterday, the leading economic indicator that came out at 10 a.m.
Not good.
Came in strongly in recessionary territory, really deeply negative. How much does it sort of edify a feeling that we are heading towards something, albeit a drip by drip by drip, not necessarily a catastrophic collapse?
To be specific, to be really specific, when I'm talking about the unknown beyond May, I'm not talking about rate hikes. I'm talking about their understanding of tightening of financial conditions and lending standards from the financials, from the banks. Patrick Harker talked about that over at the Federal Reserve. I expect to see tighter credit conditions for households and businesses that may slow economic activity and hiring. We understand the direction, but the full extent is still unclear. That's about the magnitude. I still don't think we really know what the rest of this year is going to look like on that front.
We don't know what the rest of the week is going to look like, even though it's Friday. I mean, honestly, like they're in the unknown territory, but so is everybody else.
Equities right now softer by about 1/10% to wrap up the trading week in the equity market. Let's run through things for you. That's stocks. Let's look at bonds as well, with the yields basically unchanged. On a 10-year, 352.61 in the FX market. Euro dollar backing away just a little bit, down 0.2%, 109.51. I have to say, Lisa, over the last couple of days, pretty tight trading ranges for the single currency against the dollar.
Yeah, and it has been sort of this stasis as people game out what's going on. Honestly, it's been a trading range pretty much everywhere, and it's been frustrating for a lot of people. Calm that seems to belie some of the angst underpinning it. We just got Regions Financial, the latest of the regional banks coming out. They actually beat expectations pretty much across the board, although provisions for credit losses came in slightly above expectations, 135 million versus 122.7 million. But if you take a look at the net interest margin, it actually came in slightly above. This is the question of profitability, and it goes to this issue of where are the strongest going to get more strength? Are they going to consolidate today? Well, we also get H8 Fed data on commercial banks and deposits, and we'll get perhaps some more information. 9:45 a.m. We got a slew of data out of Europe earlier this morning. We get the latest from the U.S. S&P Global U.S. Manufacturing and Services PMI. The consensus from the Eurozone PMIs that we got earlier was services doing better than expected, manufacturing doing worse than expected. How long can this bifurcation happen before one carries the other? And this, to me, is a real tension as we see sort of different moving pieces of this economy. And at 4:35 p.m., is this the last gasp?
Is this it?
This is it. Fed Governor Lisa Cook is speaking at Georgetown University. The last gasp before all goes quiet.
What's left to say?
I mean, honestly, this is what we've been saying, but the fact that there seems to be a consensus.
Yeah.
Yes, that there's enough information to raise 25 basis points, but after that, probably not so much.
Hike and hold. Maybe the hike in May is the last hike of this hiking cycle. Joining us now is Luke Cower, asset allocation strategist over at UBS Asset Management. Luke, good morning to you. Great to catch up with you, buddy, as always. I want to pick up on that line from Bank of America and Michael Hartnett. You know his work well. Sell the last rate hike. How do you and the team over at UBS feel about that, Luke? Sell the last rate hike.
Well, we think equities at the headline level, quite some time haven't been that exciting. As in, that's not necessarily where you're going to see the big move, the break to the upside. Have a lot more confidence in the under the hood trades. What's been really stark for us is over the past month. What's really crazy is how much the volatility environment has normalized cross asset, whether that's VIX move, spread or in FX. All of that is below where it was before we had an episode of banking stress, but the relative value positions that really got hit very hard during that kind of short period of time where we were pricing in some tail risk with U.S. regionals, those haven't retraced much at all. So that to us is where the opportunity is tactically, much more so than focusing on whether to sell the last rate hike, because it's not even a foregone conclusion that the Fed in the cycle is done, as you guys have noted.
So Luke, with that in mind, would you expect that relative underperformance to close or for the VIX to mount higher? Which one's going to close?
So we, in our view, the trade here is that the oxygen is coming back into the room from a macro perspective. Whenever you're talking about U.S. financial system risk, that's the only narrative that's going to matter. We get that, we understand, but we're putting more and more time, distance, and data between that episode. So we do expect this to close much more so from the some of the cyclical segments like large cap financials outperforming tech, closing more than say the VIX spiking up to levels consistent with a real growth scare. That would be our call.
So you mentioned tech. Next week we get tech earnings. How concerned are you about these as a bellwether at a time when there have been some signs that chip manufacturers are still facing some real headwinds?
So with tech for us, it's the combination of the fact that even the earnings growth that they are in some places of the market they won't post it, in some they will. But even for the group in aggregate, the earnings growth they're going to post isn't that much stronger than the rest of the index to justify being priced at such a higher multiple to the index still. So it's still more of a value play that they're a lot more susceptible to mistakes. If we talk about high valuations at the index level, we all know what's driving that. So it's just it's a situation where, as you say, bad news can have more of an impact based on the initial conditions of valuation.
Luke, I'm curious also your view on China and the potential influence on tech earnings, especially because you've come on this program before and said that you were bullish on Chinese equities and Chinese bonds, this idea of the assets that have been perhaps left for dead too quickly. Do you still feel the same, both about Chinese assets and the Chinese aspects of some of these tech firms, in light of the recent discussion, the recent rhetoric, and the recent proposals from the Biden administration?
Yeah, I do think that you do have to take those kind of note of those and those risks, and that's one reason why in some cases you have to be a little more choosy about whether you're playing Chinese equities from primarily onshore or offshore perspective. That allows you to mitigate some of those risks. But to talk about that macro oxygen coming back, yes, this is the positive China story we've gotten more and more evidence, even some green shoots, things resembling green shoots in real estate over the past month. We think the market can now focus on that in an environment where the market isn't worried about pricing details. Do geopolitics kind of play a big potential role in how investors are going to treat China and perhaps keep it in a valuation penalty box? Very much, perhaps. That's something that's part of the distribution. However, would also say there's a lot of moving parts in the U.S.-China relationship right now, and to boil it down to a positive or negative headline we might see on a week-to-week basis, a lot of those kind of prophesied catalysts haven't necessarily come to fruition, and I still do think there's a lot of fluidity there.
Luke, last time we caught up, euro dollar was around 106. I believe it was March 2nd, 105.97, and we asked a friend of yours on the team at UBS for a call on euro dollar. Your dog said that we should go long, went from 106 to 110.76 on Friday. Luke, Twain made quite a call on a single currency. Where are you and the team at Kazukawa now on foreign exchange?
He's going to put me out of a job, and then who's going to buy him bully sticks, right? Oh man! But no, on the broad dollar view, I think the kind of our take here is that and kind of similar to what you've been saying, the Fed sometimes when it talks about tightening has talked about tiptoeing through a dark room. Now that the Fed is tiptoeing through a dark room where they know there's broken glass on the floor, they're going to be a little more cautious even if they go beyond May. That for us, from a distributional sense, it cuts off the right-hand tail side of the U.S. dollar smile. So the only way to get USD meaningfully higher is starting to price in recession, and we of course don't think that's an imminent factor. So from a distributional sense, we still do very much like the short USD thesis here.
Luke, you're one of the best. We appreciate you, mate. As always, it's good to catch up. Luke Howard there of UBS Asset Management. I promised we wouldn't talk about Man United after last night's results, so we will not talk about Manchester United. I will talk about this, though. Shout out to Philip Holdrick in London for the team here at Bloomberg for putting this article together and drawing my attention to it. Bank of England policymaker, have you seen this story?
Yep.
Silvana Tenreiro, who Tom caught up with on Friday at the International Monetary Fund World Bank spring meetings, said this about her hawkish colleagues, compared them to, quote, a fool in the shower, Lisa, who scolds himself by being too impatient to wait for the water to warm up, saying interest rates are already too high for the economy to bear. A nod to Milton Friedman there in that quote. What do you make of that? A fool in the shower?
This is the fear that a lot of people have, is that at this point, people, Fed officials or ECB officials or Bank of England officials are catering to the previous crisis and the previous mistakes and not gauging what the risks are in real time.
It's a clear shift in 6 months from worrying about doing too little to worrying about doing far too much. Priya Misra in the next hour. We'll catch up with her on that and a little bit more in this bond market too. Priya Misra of TD. In the bond market right now, yields unchanged. Let's call it 353 on a 10-year. The equity market going nowhere on the S&P 500. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Prime Minister Rishi Sunak's deputy, Dominic Raab, has quit after investigation into bullying complaints. The The probe criticized Ra's behavior toward civil servants. It's a major blow to Sunak. He's tried to present his government as a contrast to the Boris Johnson era, which was marked by political scandals. Federal Reserve officials are backing another interest rate increase. At the same time, they're monitoring the economic fallout from stresses on the banking system. Cleveland Fed President Loretta Mester says she favors getting rates above 5% because inflation is still too high. Atlanta Fed President Raphael Bostic says he backs a one-and-done rate hike approach. President Biden will crack down on U.S. investment in key parts of China's economy. Bloomberg's learned he'll sign an executive order in the coming weeks that will limit investing in Chinese semiconductors, artificial intelligence, and quantum computing. The president's hoping to get the backing of its G7 partners. And Elon Musk is doing an about-face. After saying he would continue to drop the price of his EVs, Tesla is now increasing the cost of its Model S and X vehicles in the U.S. Prices for high-end models will be bumped up by $2,500, raising the cost of the sedan and SUV by 2% to 3%. Steep markdowns already this year took a toll on profitability and Tesla shares. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think in the end of the day, crisis is too strong a word, and words like that get used a lot. The good news is the basic industry has reported good earnings across the board. Deposits have come down, but that's intended by the Fed taking money out of the system. It's got to come out of somewhere. Banking system is what they want to do to, frankly, make credit tighter and help slow down the economy. So that's gone on.
That's Brian Moynihan there, the Bank of America CEO, speaking yesterday during Bloomberg's Southside Leaders Forum in your equity market this morning. Welcome to the program and good morning. Your market looks like this, basically unchanged on the S&P 500 as we go towards the weekend. Yields unchanged as well on a 10-year maturity, 352.80, anything but unchanged when you look at Tesla over the last 24 hours. This stock got absolutely hammered post-earnings yesterday, down by close to 10% off the back of margins coming in a lot more than anticipated following price cuts. Yesterday, more price cuts. This morning, price increases on the high-end Model S and Model X in the United States. Are you keeping up with this one, Bremo?
Don't you feel like there's just, a dartboard and he's just like, oh, let's try this one. I don't know, maybe let's try this one and see what happens.
Well, he was busy with SpaceX yesterday, but clearly to return back to Tesla and get the focus there. Ford's Jim Farley says Tesla and this pricing activity of the last couple of months could start an EV price war. I don't think that's going to be news to many people. I feel like that's where this is heading.
Well, he said that the moves to bolster growth are, quote, completely rational and should surprise no one. To your point, this is exactly what's been expected, and you could argue that it was actually started by Chinese manufacturers of electric vehicles, which are dominating the industry and really could be said to be Tesla's main competition right now.
Highly desirable for the consumer. Some of these vehicles, particularly EV, are so expensive. The government's trying to make them more affordable with credits and all of these rebates and all that good stuff. You see that effort around the world at the moment, but certainly this is what consumers want to see. And we caught up with, who was it yesterday? Julian Emmanuel?
Yep.
We said, is this idiosyncratic?
Macro story.
Pushback said it was a macro story.
And that's the reason why I think that the earnings that we get next week with respect to the big technology companies will be really important if they signal a similar kind of pushback from the consumer in terms of pricing.
Tons of bank earnings over the last couple of days. As Lisa pointed out, we go from banks to tech next week. Let's talk about the banks right now. We can do that with Mayra Rodriguez-Valadares, the Managing Director, Principal at MRV Associates. Mayra, wonderful to catch up with you. I really want your thoughts on the regionals, the small banks first, and maybe we can shift back to some of the bigger lenders in just a moment. Lisa jumped all over it yesterday, the net interest margins, the profitability story. Do you think it's too early to see some of the pain, to see how this is going to evolve over the next coming quarters?
Yes, definitely. We have to remember that the banking turmoil started really the second and the third week of March. And by that point, the vast majority of regional bank strategies, all their transactions were well underway. And they certainly have benefited from high interest rates. They have definitely been charging more on a variety of loans and credit facilities, but they haven't been paying more as much over on the deposit side. And so that net interest margin really benefited them. However, I do see a few trouble spots in the horizon.
Like what?
Well, you definitely see just about every single regional bank increasing their provisions for credit losses. And some of them had even released them a couple of quarters ago. And so that's certainly a big sign that all of these banks are preparing at worst for the beginning of a recession or at best for a softening of the economy. You also, of course, had a lot of banks had a decrease in deposits. And for regional banks, this is incredibly important. Anywhere from 75 to 85% of their funding comes from deposits. They're not diversified like the globally systemically important banks. So it's very important to watch not just the level of their deposits, but the diversity of the deposits. And that can be really hard for some of the really small regional banks because by definition, they're concentrated in the communities and regions that they serve.
Mayra, there's a lot there to unpack. I want to stick on the loan loss provisions. There are two ways to read this. One is that they're continuing to lend more aggressively and just provisioning for more potential losses, or they are withdrawing some of their lending prowess on the heels of some of the deposit outflows, as well as the concern about loan losses that keep ticking up. Which is it?
You know, unfortunately, the answer may not be so satisfactory to investors. It's a bit of both. There are a lot of signals in the economy, in the market, that we really do need to pay attention to. We've got a lot of tech companies, consulting companies, retail media that all little by little have been announcing layoffs. So how are these people eventually going to pay their mortgages and their other credit facilities? You have American companies at their most indebted level in history. Many of those loans are leveraged, which means 6-7 times debt over EBITDA. The Beige Book just this week already stated that some of the banks had already been tightening their credit conditions. So a lot of these banks are actually exhibiting good risk management when they increase their provisions. And I'm not seeing big rises in lending. You have trouble areas over in the auto loan sector.
Yeah.
You're already seeing high housing prices in the West. So there's a lot there to remind banks they need to remember the religion of good risk management.
Myra, yesterday at 4:30 p.m., we got some data from the Fed on the latest emergency borrowings from that discount window as well as a new program. I almost laughed at the way that it was interpreted. The optimist said this shows stability. The pessimist said this shows that people are still drawing down on some of these emergency facilities. How would you read the fact that we saw the first increase in usage of some of these operations in 5 weeks?
Yeah, that's a great point. The banks should no longer be borrowing if they're as stable and as liquid as they say they are. And this is one of the reasons why legislators and regulators really should be demanding that banks be more transparent. By the time that you and I get some of their liquidity metrics, such as the liquidity coverage ratio or deposits as a percent of total funding, it's already too late. That information is old. But any of these facilities from the Fed is not the way that banks in a capitalist system should be running. They should be depending on their own cash flow, and that's why that most of them need to be much better managed than they currently are.
Myra, just to finish on this word, crisis. Would you call it a crisis? This time last week, Mohamed El-Erian was with us, and he said this is not a crisis. Brian Moynihan, Bank of America, not a crisis. What's in a word? Why is that word so important?
It is incredibly important because unfortunately it starts to really be overused. This is bank turmoil caused by serious lack of good risk management. And there's really no excuse for that. Silicon Valley Bank, Signature, all of those banks needed to have been back on the basics a long time ago of managing their interest rate risk, managing their liquidity. We have to be very careful not to overuse words. This is banking turmoil, and it is not a crisis. A crisis is when we're really talking about massive interconnections with banks and the real economy, as well, of course, as corporations. 2007, 2009 was a crisis. This is not a crisis, and I'm really hoping that it doesn't go that way.
Myra, appreciate your perspective, as always. Myra Rodriguez Valladares there of MRV Associates. This from Mohamed just yesterday when I caught up with him. We talked about that briefly. He also said this, it's not a credit crunch. He said this is a credit contraction. There's a difference. A credit crunch is economy-wide. It has massive implications. A credit contraction has distribution effects, and we should focus on those.
This is the reason why people are having such a difficult time understanding the trajectory of the economy and just how significant the credit contraction will be, because we're used to 2008 in terms of the reference point. This is not 2008. This is something different. There is a slow-moving burn. And yet, bank turmoil, bank crisis, bank tremor, bank kerfunkel, at what point do we just call the whole thing off and then wait a second, maybe not?
Yeah, I just don't like it when it becomes dismissive and goes the other way. So on the one hand, you can say it's not a crisis, but on the other hand, you've got to make sure that you also don't say it's something you should ignore.
Well, exactly. You can't say just because it's not 2008, we don't care, right?
Exactly.
That can't be
There's
the
nothing
only,
to see here.
Right, exactly. Just because we're not seeing all banks, in a flaming pile of distress doesn't mean that,
Benchmarking to the extreme is problematic.
Well said.
From New York City this morning, good morning to you all from a beautiful New York. This is Bloomberg.
what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for the, if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Two days without any gains on the S&P 500. Will it become 3 on the S&P? Right now, equity futures are negative by about 0.1% on the Nasdaq, with softer, lighter, lower negative, down by 0.2%. Into the bond market, 2s, 10s, 30s. The 2-year looks like this at 4.11. It spent the whole week above 4%. Backing away yesterday, though, off the back of weaker than expected economic data, claims coming in a bit higher than anticipated. That trend, is it a trend? I think some people are starting to call it that. Yields are lower by 3 basis points on a 2-year to 4.11. Your 10-year, 352.61. I want to finish on euro dollar. Very tight trading range over the last couple of days. 109.64 on the euro. The Fed, largely uncommitted to more rate hikes beyond May. It's about a pause now, as Lisa pointed out. The last day of Fed speak before the quiet period ahead of the May 3rd decision. Lisa Cook on tap following a slew of officials making the case for just one more hike. Philadelphia Fed President Patrick Harker saying this: rates are close to where we need to be. We need to be a little cautious here to not just respond to the current level of inflation, but where we think it's going. You know, Lisa, this is interesting because Mohamed El-Erian talked about this yesterday as well with me. He said this Fed, and I think he said this on Friday, last Friday too, is too sensitive, too data dependent, and needs to take a longer term view on where they think this is heading, and ultimately talk about some of the secular issues at play here as well.
Do you think they agree on the longer term view?
No, based on the range of estimates next year, absolutely not.
Which is part of the issue, because fundamentally we don't know what the destination is, and this is coming at a time when, okay, now pause talk will talk about what is the threshold to cut, because right now we're still pricing in cuts in the market this year. How much does the Fed push back against that, or do they basically let the market decide for them, which is kind of how they've been operating for a little bit of time now?
I was just jumping into the summary of economic projections on the terminal from the Federal Reserve. The range, never mind the median, let's talk about the range for Fed funds next year, 3.4% to 5.6%. They're the numbers behind that answer, no. They've got no idea.
But, you know, even when we talk to economists, they don't have an idea either. They say it could go either way. A lot of people say, look, this is a very difficult time with a lot of distortions, and underpinning it, I think, really will be the data that we get at 9:45 a.m. and what we got out of the Euro region, which is a complete bifurcation between manufacturing and services. How do you put those two things together when it's psychological? People want to get out and they want to explore. You're laughing because I'm going to go off therapy on us on a Friday, but it's like people are willing to spend what they have on an experience, but they've already bought the stuff that they need.
Is flying an experience?
It is an experience. Yeah. I mean, you can put whatever adjective that you want on it, but yeah, it's the whole trip mentality.
What did Ryanair's CEO tell us earlier this week?
Boomier and boomier.
Boomier and boomier.
Yeah.
That's kind of nuts, isn't it? Double-digit fare increases, and he thinks we're going again, double-digit fare increases this summer.
And that's for a budget airline. That is for somebody catering to people who are the most price sensitive. We all talk about it when we look at flight prices and how much they've gone up.
Alan Ruskin flies Ryanair. He joins us now. Chief International Strategist over at Deutsche Bank. Alan, great to catch up with you, sir. Thanks for being on the program with us. We're discussing this last hike, and a lot of people I know do a lot of work about the last interest rate hike and what happens after that. It's always easy, though, with hindsight, to identify the last hike. Alan, do you think it's easier this time around to identify what the last hike of this cycle is going to be?
John, unfortunately, I don't think it's easier. I agree entirely with the discussion you had earlier that the Fed and the market are faced with all sorts of uncertainties. We don't really have a huge amount of experience in terms of credit crunches. We have to sort of go back to really 2008 was a particularly unique experience, or otherwise probably more familiar is really early 1990s. So there's a sense that credit conditions are tightening sharply from a quantitative standpoint, but when you actually look at financial conditions from a price standpoint, they're actually easing. And it's this dichotomy, I think, that the Fed's wrestling with, and not enough history to fully understand the quantitative effects. So I can easily see why you might see a pause and then a reignition of a rate hike. In this cycle, there's more possibility of that than in past cycles. So I think in that sense, the identification issue is more problematic than usual.
What are you looking at, Alan, when you talk about that, given that so many people say inflation readings are actually coming down much more quickly than expected? What do you push back against that with this idea that actually perhaps the Fed is underestimating those impulses?
Yeah, I think you're looking at a little bit, again, of this differentiation between what's going on the good side, where I think you're seeing excess supply kicking in, whereby, supply was looking at being unable to meet demand, and all of a sudden it's in excess supply, and supply deliveries are improving quite dramatically. So you've got the good disinflation story that I think is for real. I think the services side is much more problematic, and again, there does seem to be underlying demand. So I think when you've got indices like you saw in Europe today, like I think you probably still see in the US as well, whereby the service sector is seriously outperforming the manufacturing sector, then in all likelihood, services inflation and wage-related inflation, again related to the service sector, is going to remain obdurate and pretty stubborn. So I don't think the Fed's going to be in a position to cut rates very, very easily. And I think the talk from the central bank, which is accurate, is that there is going to be more of a plateau period, that they cannot cut rates quickly or can't shift from rate hikes to rate cuts very easily.
A lot of people are reading this as negative for the dollar, and that's probably why we've seen such strength in the euro, perhaps surprising some people with the resilience of it. How does that play out for the remainder of the year if the Fed does finish with one more hike in May and signals that that's it?
Yeah, I think, when you look at the way markets have traded once you get confidence that the Fed rate hiking cycle's done, then there's some real standout trades. The most obvious is obviously bullish bonds, front-end steepeners. You get the dollar generally weakening. And I don't think we're going to be an exception this year, particularly in the context of the ECB hiking rates when the Fed might well be cutting rates, towards maybe the end of this year. So I think that is I think the central view that's out there. But just because it's only partially priced, I think the euro's still got plenty of run, and it's also happening against a background where the European current account position is improving, and related to the interest rate changes, the capital flows are improving as well.
Alan, when you say more room to run, what do you mean by that? From 110 to what?
Yeah, look, I think we're being quite conservative in terms of forecasting 115 at year end. It doesn't mean that you can't go above there, but that's the DB forecast. There's obviously an active debate in terms of how high this can go. Typical ranges for the euro are at least 10% in a year like this, where there's a reasonable amount of volatility. But I think the broader point, John, is not so much where we're going to end this year. I think this is a trend that can continue well into 2024, when you start to get into a much more serious Fed rate cutting cycle. And then, you're talking about 120.
Well, you touched on the projection that underpins the projection. It's the projection around rates of the Federal Reserve and also the ECB. Alan, I think we've got a decent idea, perhaps, of terminal rates at the Fed relative to where we think the terminal rate might be over at the ECB. Is that the way you see things?
Not really. I think we can see a terminal rate, that the market's pricing, and I think it's roughly around 3.75, 3.8. That's not unreasonable, really. Somewhere close to 4%, I think, is reasonable. I think the market underestimates the extent to which the labor market in Europe is tighter than almost anywhere in the rest of the world when one looks at unemployment rates relative to long-term averages. So I think there's considerable pressure from the labor market onward to underlying inflation pressures that will keep the ECB, in a pretty much a tightening phase through 2023.
Wow. Alan, thanks for that. Alan Ruskin there of Deutsche Bank. A roundabout way of saying that the ECB might go a lot higher than you think they're going to go.
Another way of saying that if Americans want to visit Europe, probably they should do it now rather than, in a year from now when the dollar is going to be substantially weaker. That's basically what I heard. Maybe I am hearing something quite
Convert your
different.
currency. We don't get the parity party of last summer.
Yeah, basically that if this whole sort of cheap option to go to Europe is looking less cheap, I mean, putting out the frictions of airplane costs and hotel bills. I feel like I'm sitting in Tom Keene's seat and I'm just channeling his spirit right now in terms of the lens that I'm viewing this in. But absolutely, this feeling that Europe has a longer runway and the U.S. is a bit more fraught.
It's highly dependent on the rest of the world. If you get the Federal Reserve cutting interest rates and the rest of the world is still doing okay, I think the idea that you get a weaker dollar off the back of that makes sense. If the rest of the world is not doing okay, the Federal Reserve is cutting interest rates and you have problems in Europe and China starts to fade a little bit, then you wonder whether you go to the other side of the dollar smile, so to speak, and the dollar starts to perform again. That's a different argument. I just don't think that's the consensus view right now based on the numbers we've seen from Europe this morning and the numbers we had from China earlier this week.
Well, we've had the UBS's